Cash equity, Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Global reverberations, Asian stock slump as SVB fallout spreads. The market turmoil prompts Nomura to predict the Fed will cut rates next week, while Goldman Sachs sees a pause. US CPI is also in focus today. Bitcoin extends the biggest gain since November after US authorities moved to stabilize sentiment. We speak this hour with Jeremy Allaire, the CEO and co-founder of digital currency company Circle. Plus, Credit Suisse finds material weaknesses in its financial reporting. That's as the embattled lender releases its delayed annual report.
Tom, and this is what futures are telling us. Of course, we look at that CPI print after the Armageddon-like bank seizure that we saw in, global equities yesterday, bank equities. Today, we now look at what the Fed does next after that CPI print, and because it's expected to capitulate, maybe stocks are getting a little bit of a reprieve from that.
Yeah, the estimates around the CPI are 6%, coming off the 6.4% in January. This is the February number, of course, that we're looking out for. The importance of that inflation print, whether it can give any clarity to these markets, of course, whipsawed by the fallout as SVB, and the banking sector in Europe felt so much pressure. You saw that reflected in the FTSE MIB over in Italy in particular, but the whole of the banking sector, of course, under pressure. You saw that reflected again in the Asian session today. So we'll check in on the banking sector in the next few seconds. In France, the CAC currently gaining 0.2%. The Spanish IBEX in a different direction, losing 22 points just at the first few seconds of the open here. The FTSE 100 range bound. We're looking at the wage data coming out of the UK. The analysis from Bloomberg Economics is that you're still going to see a rate hike from the Bank of England, even as some of the Labour sector tightness, some slightly ease, particularly around wages. But nonetheless, again, Bloomberg Economics thinks there is going to be a hike nonetheless from the Bank of England at the next meeting. There's the FTSE 100 currently off by 0.1%. Over in Italy, after the losses of yesterday, a little bit of stabilization coming through, at least in the first few seconds. Let's have a look then, cross-asset for you, as we look ahead to the US, weighing up the importance of the inflation data, and of course, question marks still continuing over whether or not those regional banks have been ring-fenced by the action of the Federal Reserve and regulators in the US. Futures currently gaining 0.4%. Here's the action, though. The 2-year, that 61 basis point move lower in yields yesterday, moderating today. Currently, 3 basis points move lower across the front end. 394 on your US 2-year. Germany as well pronounced a record move into German bonds yesterday, 245 on the 2-year. Again, another big move, massive move in terms of money flowing into German debt, 23 basis points, 24 basis points. And the Bloomberg Dollar Index supported 0.22% for the US dollar. A little bit of strength coming through for the greenback. Francine.
Tom, let's dig a little deeper into some of the sectors. So a lot of them are actually in the green. I have about 6 that are seeing a bit of pressure. So I have insurance, auto parts, financial services, and banks down 0.7%. We also need to watch out for Credit Suisse. They actually said, look, they found some financial things, and so they're not reporting in their annual report right now. So we're seeing that stock under pressure. Overall, it's financial condition tightening that is, for me, without a doubt, the name of the game today. We saw that overnight and what that means for the Fed going forward.
Now, that uncertainty, of course, over whether the Silicon Valley bank crisis could change the Fed's course of action over the coming months has triggered, of course, some major moves in these bond markets, as we flagged there, particularly reflected currently in German bonds. US Treasuries have steadied, though, today after what was a hugely volatile start to the week, historic, really, and the rally has extended into Europe, again, with German bonds gaining and in focus for us today with that 23, 24 basis point move. For more, let's bring in Ven Ram from our Bloomberg MLive team. Ven, what a couple of days, particularly at the start of the week for the European debt markets. Where is the focus today? Tie in the preview and the expectations around the inflation number out of the US and how challenging that could make the Fed's job going forward.
It's an absolutely bizarre week for the Fed, no doubt, Tom, because obviously, as you mentioned, we've got the inflation prints. On the one hand, we have got a chronic inflation problem in the US. That doesn't look like it's going to go away anytime soon. I think regardless of what the print we see today, whether it's higher than or softer than forecast, I think the central problem is one of inflation running well above target, and I don't think there's going to be any discontinuity with that story. But what matters much more for the Fed today is what happens with the markets. The tumult that we saw yesterday with 2-year yields, Treasury yields slumping the most since 1987, that's not what they want to see. If that mayhem continues in the markets through this week, the Fed will hold rates next week. There is no question of them raising rates in a backdrop like this, where liquidity is an issue, where systemic confidence is being threatened. That is what matters to the Fed much more than inflation. Of course, if the tumult slows, then it's a different question.
Ven, thank you so much. Ven Ram there from our Bloomberg MLive team. We also have a great chart looking at financial conditions and how they tightened in the last 72 hours. We'll do that with Jim Bianco. Now, European bank stocks tumbling in the wake of the SVB crisis over fears of a broader contagion. So for more, we're joined by Bloomberg Finance, of course, team leader Tom Metcalf. Tom, why have European banks been so affected by SVB?
Yeah, well, it's really just sort of that sense of this mismatch at SVB and some certain tech lenders between the sort of assets and liabilities. So the sense that, you might be locked into lower rates and then, you're losing money now as the rates have sort of turned against you. Now, that was an extreme case at SVB, but I think investors are kind of looking around and going, this is maybe this is a problem hitting all the lenders to various extents. So that's why you've kind of seen that sentiment drag down. And then, of course, there's a few unique cases around certain banks.
And Tom, Credit Suisse finally unveiling and releasing their annual report. I'm looking at the stock currently down around 3%, Tom. But of course, after the bloodletting for Credit Suisse of yesterday, down about 10%. What do we know about these material weaknesses they flagged?
Yeah, this is sort of material weaknesses, kind of accountancy speak for we didn't do our financial reporting correctly, which is obviously not great if you're a bank in particular. And effectively what appears to be the case is last week the SEC came out and said, hey, you need to look at how you accounted for your cash flows in 2019, 2020. It appears Credit Suisse has done that work, and guess what? Found out that actually, they've also got some flaws in their kind of controls processes, how they sort of record things for 2022 and 2021. This is not the kind of release you want, particularly for a bank like Credit Suisse, which has just been going through so many issues recently. So yeah, more bad news for them. And yeah, very, very curious to see how the shares do today.
Okay, Tom Metcalf from our finance team, of course, on the banking sector and Credit Suisse. Thank you very much indeed. Now, we're very pleased to say we can bring in now Jim Bianco, president and founder of Bianco Research. Jim, thanks so much for coming to the studio. And you've been comprehensive in terms of how you've broken down the SVB story on your Twitter handle. And you've been really incisive in terms of pointing out two particular factors. I'm thinking about technology and liquidity, and then the mismatch between deposits and, of course, what you're getting in money markets. Just break down what the implications are for those two factors coming to play.
Yeah, so from the technology standpoint, welcome to the era of mobile banking. How did SVB get $42 billion withdrawn on Friday alone when there was no images of people lined up in front of the bank? It's this thing right here. It's our phone. I already had one tech VC told me he opened an account with JP Morgan and transferred $200 million in 10 minutes. So the banking system has to understand that the $17 trillion of money, everybody's sitting here with their thumb ready to move it at a moment's notice. And so they have to come to grips that this new technology has removed the friction of moving your money from one account to another or one institution to another at lightning speed. And so this is going to be something regulators and bankers are going to have to kind of get their head around. As far as liquidity goes, The bigger issue here is that for 14 years, we had 0 interest rates. Bankers that are now running these banks are used to a 0 interest rate world. When rates started to rise, because of all the QE, they said, I have enough reserves, I don't need any more assets. So they kept their rates at 0. As rates went to 2, 3, 4%, customers didn't move. But then at 5%, something happened. The money flow, the gates opened and money started flowing into money market funds. They started buying treasury bills because 5% versus 0.5%, then they started to move. And that has now created this liquidity drain at all banks. But the weaker ones, like a Signature or like an SVB, they're the ones that we found having the problems first. That bigger problem still consists now, that everybody's still looking around and saying, even after the sell-off, I can still get a 4.5% T-bill yield. I can still get 4% on a traditional money market. Why don't I leave my bank and go to that?
So, Jim, first of all, First Republic Bank shares in pre-market are up 20%. We'll talk about regulation. We'll talk about Tier 1 and Tier 2 banks and what that means going forward. But do you think the bank run will continue?
The bank run will continue, but maybe not to the point that you will get a failure. You got to ask yourself, and this gets to this whole idea that it's a 2-tier banking system. Tier 1 is the 4 big cannot fail.
Too big to fail.
Right, too big to fail banks, the Citis, the JP Morgans, Wells Fargo's, B of A. Tier 2 is everybody else. Tier 1, you are a depositor with that bank because they're too big to fail. But Tier 2, are you an unsecured creditor or are you a depositor? If you perceive yourself as an unsecured creditor, which a lot of these large companies do that are well over the $250,000 limit, why wouldn't you move to a Tier 1 bank? So I think a lot of people are going to make that calculation, and they're going to say, okay, my bank is not going to fail tomorrow, but they're offering me 0.5%, and if they do run into trouble, but what's the downside for me to move my money to Chase? There's no downside. It's 10 minutes on my phone, and that's what bankers are going to have to deal with.
And one of the best read stories on the Bloomberg right now is around how those top 4 or 5 banks in the US have just been sucking in those deposits. So the bigger question then about how that leaves the financial sector of the US after all of this is unwound.
Yeah, that's going to be a problem. I think that the regional and small banks, there's 2 ways they can get around this. The first way would be if you had unlimited deposit guarantees, at least for now, to tell everybody that you're now a depositor at a regional bank, you're not an unsecured creditor. Now that brings up a moral hazard, and that brings up the idea of a bailout, and that is a problem. But if not, you're going to continue to drain all of these regional and small banks. Like I said, not in 2 days, but over time. The other thing they could do is offer an incentive. Why don't move your deposit rates to 3, the interest you get on your savings account, move it to 3, 4, 4.5%. Whereas, yes, if you want to go to JP Morgan Chase, they're going to offer you 0.5%, but I'm going to offer you 3 or 4 to stay here. At least make me think about it. Because if you're going to offer me half here and they're going to offer me half there, I might as well just move. But the problem with that is that kills the bank profitability. So they're in a bad place.
But Jim, Treasury has effectively actually guaranteed all deposits, right, for all banks. Or are we reading it wrong? Through facilities and lending, but the overall message has been that.
Right, the overall message has been Treasury has offered liquidity to the banks, but all that means is that if you want to leave, the bank has a facility to get the money for you to leave. They haven't told, remember, we're going to talk to non-financial people. We haven't told you that your deposit is guaranteed.
Right.
We've told you that if you want to leave, your bank won't close. That's not a comfortable guarantee. They've only guaranteed all of the deposits at Signature and at Silicon Valley Bank, but they haven't said that everybody's deposit is guaranteed everywhere.
But do you think they should do that? I mean, you also have crypto banks. If you look at moral hazard, this is it.
Right. Well, they did that in 2008. The FDIC did, through their TAG program, guarantee everything at every bank for 1 year. So we have a precedent for it. But if you wanted to stop the run, because if you wanted people to stop thinking I'm an unsecured creditor at a regional bank versus a depositor at a big bank, well, you could change that with that, but then that brings up a whole host of other problems.
Jim, thank you so much. Jim Bianco, their president, founder of Bianco Research, stays with us, and we'll talk about the Fed next. Could U.S. CPI data provide a reality check for markets after the failure of Silicon Valley Bank? Well, we'll discuss that next. We'll also talk about financial conditions. For me, the chart of the day. This is Bloomberg. you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make. So the SVB crisis has raised the question of what's more important for the Fed, taming inflation or actually ensuring stability in the financial industry. Well, playing into the mix is the latest U.S. CPI print due later today and what it could mean for future rate moves. Still with us, Jim Bianco, president and founder of Bianco Research. I was also reminded actually that the Fed was created in the aftermath of 1907, the panic of 1907, which was basically when the U.S. was reliant on one bank. But if we leave that to one side, it's incredible, Jim, to look at financial conditions, how they tightened, the sharpest one-day tightening, I think, outside the Lehman and COVID crisis. How much does this complicate the Fed's job?
It incredibly complicates the Fed's job. If we were to assume, and I think it's a safe assumption, that this financial crisis will not be the end of civilization, that it will be resolved at some point, maybe not tomorrow, but eventually, that we'll be left with where was the economy last week? Inflation was running hot. There was concern that it might bottom and pick up in the second half of the year. And if this results in the Fed having to not raise rates or maybe cut rates and stimulate the economy, we could, in the aftermath of this, the second half of the year, be stuck with an even bigger inflation problem than we already were perceived to have. Because remember, last week, the Fed, Jay Powell was talking about raising rates 50 basis points because he was so worried about inflation. Now he's going to wind up cutting rates. And then what's going to be the inflation rate in the second half of the year? So I am concerned that we could wind up with a worse inflation problem.
Are you overlooking the disinflationary effects, though, of the financial conditions tightening, the loan standards that we know are going to be changed likely on the back of this fallout? That's going to have a disinflationary effect.
Well, that's what I meant by, that we will eventually get past this problem. It depends. Now, yes, if this turns into a full-blown crisis of 08 style and we wind up with a bad recession, then the inflation problem is put on the back burner. But I don't necessarily think that this is going to be this, because this is a liquidity problem. This is a problem that people want to pick up their phone and they want to go to a safe bank. This is not banks made bad loans and those loans have gone bad and that they're in trouble. This is that they are looking to probably move their money around. So that's why it's solvable, this problem. And then we could be left with an economy that's okay, and we've now stimulated an inflation problem.
So do you expect the Fed to capitulate, actually, and even possibly cut next year?
Next week, yes. There's a possibility that they could do that. If it all depends on what the financial markets do this week. If we were to see another downturn in the stock market through the rest of this week, then yes, I think that there's a possibility that they can. Look, at the end of the day, we cannot...
Sorry, cut next week? I was thinking about next year. You think they could cut next week?
They could cut next week if the stock market takes a big downturn again. At the end of the day, let's not forget, the Fed is a political animal, and they don't want to be blamed for this problem by raising rates into the teeth of a financial crisis. If the stock market stabilizes and rallies, that opens the door. And you can see it in the odds and the probabilities. They move tick for tick with the stock market.
Yeah, and you're seeing a bit of stabilization in the banking sector now. I mean, downside of about 0.5% across the sector here in Europe, but the funds or the futures, the pre-pricing, pre-market pricing around some of those regional lenders is looking to a bit of upside. So a little bit of relief across these markets. It was Nomura, of course, that came out with that call that maybe you get a cut from the Fed next week. But there's the debate between the likes of BlackRock on one side saying, no, they're going to have to stick with 25 basis points at least. Blue Bay Asset Management as well, saying, look, the bond markets are getting ahead of themselves in terms of repricing the Fed. Where do you see the terminal rate then by year end?
Well, yeah, you can either go either way. I can make you a case next week of 25, nothing, or a cut, depending on what we see in the rest of the week. I think that once we get past this problem, I could see the terminal rate, which is now at around 4.75 to 5, drifting back up to the mid-5s one more time, because again, I don't perceive that this is going to be a rerun of 08. I then perceive that we're going to resolve this issue. Like I said, it might take a month or two, and then we're going to be back to worrying about inflation, and that's why the terminal rate will start to drift back up.
Jim, overall, and we're here in Europe, we've been looking also at the fallout from a lot of the European banks. Is there a worry that the revenue stream will be hurt because they'll have to offer more money to depositors to keep them there, and also in general that they're going to be slammed with much more regulation?
Yes and yes. I think on the deposit rate, you've woken everybody, to use my prop again with the phone. Now we've all logged onto our phones. Now we all know how to use our phones, and now we all are noticing that there's money market funds that are out there at 4%, and it's two buttons to move my money to get 4%. If the banks want to keep that money, they're going to have to start competing with the open market rates of 4.75 on the funds rate, 4.5 on money markets and treasury bills. That hurts their profitability. They don't want to do it, but they might be forced to do it. And yes, there will be calls for regulation, and that's going to crimp them as well too. So there's going to be some lasting effects on the banking system because of what's happened.
Jim, what's the next shoe to drop? We had the LDI crisis here in the UK last year. We got the SVB Silvergate crisis now. What is the next shoe to drop? We're seeing credit spreads blowing out in some corporate credit. Are you worried about credit? Is there something else that you're watching for?
Yeah. The old adage that the Fed raises rates until something breaks, and we're finally starting to see that. I'd have to say that the next shoe to drop is going to probably be commercial real estate, especially office real estate. Work from home, remote work, we're still building buildings. We're still hoping people are going to go fill these buildings one more time. And yet, this is like the third week. We're at the 3-year anniversary of basically going to remote work and work from home. And we're only at 50% usage in the United States of office buildings. And a lot of office loans, a lot of commercial real estate loans tied to office towers, I think is going to be the next issue that we're going to have to grapple with.
Okay, what a pleasure to have Jim Bianco in the studio with us, president and founder of Bianco Research, on all things, of course, around the fallout as SVB and what the implications are for the Fed and what the other shoe could be to drop. Real estate, commercial real estate, keep an eye on that one. Thank you very much indeed. Right, coming up, we're going to hear from Arno Antlitz, the Volkswagen CFO and COO, about the company's latest earnings and this huge ramp up in investments that they're planning. That is next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has 2 targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
First and foremost, it goes into products. If you distinguish between ICE and BV models, more than 2/3 of the investment goes into electrification and digitalization, basically in electric cars, great electrical cars for our brands. Then we are transforming plant by plant to electric, and we are also investing in battery and upstream technology, because we think having the right batteries secured, basically both in terms of supply and in terms of pricing.
Okay, that was Arno Antlitz, the Volkswagen CFO and COO, on their electric vehicle investment plans as the company bids to compete with the likes of Tesla. 180 billion euros is the plan over the years ahead. The stock currently, Volkswagen, down 3.4%. Credit Suisse also in focus for us today. The stock taking a hit once again after the almost 10% drop of yesterday. The company, of course, the Swiss lender, coming out saying it's going to adopt a new plan to fix, quote, material weaknesses in its reporting and control procedures over the past 2 years. That's following conversations and talks with the Securities Exchange Commission in the US. Again, Credit Suisse down 3.7% on that news, Fran.
Now, John Arthur has put it best. The market is adamant that we're living in historic times, he says, so it's best to treat them accordingly. Now, look at that pre-market. We're actually seeing First Republic down 60% yesterday, now gaining 17%. PacWest Telecom, another regional U.S. bank, gaining 12%. I have to say, a lot of the focus here is whether we found a floor. Jim Bianco saying, look, not so much until we have a guarantee for all depositors. But the one thing we need to watch out for is a one-day tightening on financial conditions, the largest since Lehman.
Yeah, and of course, tying into that is the broader banking sector as well. Here in Europe, you're seeing losses of 1.3% across the banking sector. It looked a little bit more positive, a little bit more sanguine at the beginning and start of the session, but now pointing lower by a little over 1%. We keep across these banks for you.
Coming up, we get the latest on the UK economy, including what's this morning's employment data and the collapse of what SVB means for the BOE's hiking cycle. So we look at gilts, we look at sterling, and all UK assets. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in In any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. European stocks look for direction amid the SVB fallout. The market turmoil prompts Nomura to predict the Fed will cut rates next week, while Goldman sees a pause. U.S. CPI is also in focus today. Bitcoin extends the biggest gain since November after U.S. authorities moved to stabilize sentiment. We speak this hour with Jeremy Allaire, the chief executive and co-founder of digital currency company Circle. Plus, Credit Suisse continues its slump after the embattled lender finds material weakness in its financial reporting.
Yeah, let's check in on these markets. Credit Suisse taking a hit on the back of that news. Broadly, the banking sector is down 0.8%. Across the benchmark here in Europe, you're seeing, well, it's range-bound now. The DAX is gaining 0.3% despite the pressure on the auto sector. The FTSE 100 off by 24 points. Of course, crucial is that inflation print out of the US. Estimates of 6% coming in slightly softer is the expectation versus January for the February number, and what that does in terms of the decision-making of the Federal Reserve, as of course it weighs up the tightness in the financial conditions emanating from the fallout of SVB Bank. The bond markets are pretty dislocated at this point. Yields just edging up at the front end on the 2-year, 9 basis points now in the US, just edging above 4%, but you're seeing still money pouring into German debt. At the front end, Bunds, 2-year, 13 basis point move lower at 255. Across your sectors then, let's have a look at the sectors because the banking sector remains under pressure. Of course, significant sell-off in European banks tied to the concerns around SVB and the bank failures in the US. European banks took a big hit yesterday. Currently, that sector down 0.8%. Autos also under pressure, down 0.9%. It's a bit of a split picture, though, across these equity markets. You are seeing gains in real estate, technology, and utilities. Fran.
Now, we have a great piece of research, and actually ties in quite nicely with some of the regional banks, so we have them pre-market, but actually BI just put a brilliant piece on the fact that, look, Silicon Valley Bank is not Lehman, but they talk about the European doom loop, and they say that's real, and it's worth 1.6 trillion euros pre-market, and this is really what we're watching for these small regional banks, or not so small regional banks. In fact, is to see whether we found a floor, or whether Janet Yellen and the Treasury will have to come in more to actually do some kind of more implicit backstop. First Republic Bank, you can see now gaining 15% after the huge sell-off yesterday. PacWest also gaining 10%. I guess the question is, how long does it last?
Yeah, here in the UK, gilts just edging up in terms of yields. The pound trading at 121, just down 0.2%. And staying with the UK, the labour market showing some signs of cooling as wage growth slowed for the first time in more than a year. The figures suggest an unprecedented series of rate increases by the Bank of England are now starting to be felt in the labour market, fueling speculation that rates are close to peaking. Let's bring in Bloomberg's Lizzie Burden, of course. Lizzie, break down the data for us, the importance, what it tells us about the BOE decision.
Well, Tom, it's actually a really mixed picture. And if I look in my inbox, economists are disagreeing with each other left, right and centre because, as you say, there are some signs that the labour market's cooling. You've got economic inactivity falling again, weaker pay growth, and that suggests, as you say, that the previous hikes the Bank of England's done are taking effect. That's the argument being made by doves on the committee like Silvana Tenreiro, Swati Dhingra. But at the same time, the unemployment rate held steady and the number of employees on payrolls rose above expectations despite higher interest rates. So our economists at Bloomberg Economics actually reckon that you'll get one more hike of 25 basis points and then a pause. But the March decision, of course, is also going to depend a lot on what the Chancellor does in his budget tomorrow. And as well on the degree to which financial conditions tighten on the back of this SVB collapse. Traders have been paring back their bets of a quarter-point hike next week because of this saga and for where rates will peak at the end of the year. And Berenberg's Callum Pickering, in a note yesterday, actually raises the possibility that the Bank of England pauses quantitative tightening at the next meeting, which would really be a signal that we're ending the tightening cycle soon.
Yeah, that'd be a big deal. Now, you also interviewed the city minister yesterday. What did he say about the spillover for Silicon Valley Bank?
Well, he is very confident that they've done a good job of reducing the risks over the weekend. Both the Prime Minister and the Bank of England have said that liquidity is strong, banks are well capitalised. But the most striking thing for me from Andrew Griffith, speaking to him, was he said that no guarantees have been made to HSBC buying SVB UK. Take a listen.
It was the successful bid at the end of the day. I mean, the government's interests were to get a quick conclusion to this, to protect depositors, to allow the really important firms in the tech and biotech sector to go about their great work of building the UK economy from this morning, protect the taxpayers' interests, and also this outcome delivers a good benefit to UK financial services, with HSBC headquartered in the UK, one of Europe's largest banks, standing fully behind SVB UK Bank.
And has the government or the Bank of England given HSBC any guarantees of any sort?
No.
Now, he wouldn't tell us about the other bids or whether any of the other bidders asked for guarantees, and we can note that it was bought for £1. And the other thing that we found out yesterday was that the government gave HSBC a bit of help to get this deal over the line by waiving certain ring-fencing restrictions. So that could spell trouble down the line.
Lizzie, thanks so much. Lizzie Burden there with the very latest on the UK. Now, for all of our viewers in the UK, we'll also bring you special coverage on the budget. That's tomorrow, Wednesday, 12:15 p.m. London time, Tom.
Okay, now after a turbulent day, of course, for European banks, EU finance ministers meeting in Brussels are urging calm as they stress that the euro area has limited exposure to SVB's collapse. Still, it has, of course, led markets to push back on the ECB's guidance for a 50 basis point hike on Thursday. Let's bring in Bloomberg Europe correspondent Maria Tadeo on the ground in Brussels. Maria, you've been speaking then to European finance ministers. You've been testing the water with them. They've been meeting in Brussels. What have they been telling you?
Yeah, they have been, and in fact, they still continue to be. And by the way, this was supposed to be a Eurogroup about fiscal rules, and as you can imagine, it has been completely eclipsed by this saga. I think overall, when you put the takeaways together, a lot of the messaging that's coming across from here is to essentially just state the operations of this bank in Europe are minor compared to the performance in the United States, so therefore potential risks are more manageable to deal with. There was also this idea the regulation has been improved or strengthened since the financial crisis hit the euro area. And then, of course, this idea that a lot of it was happening over the weekend. There was a lot of rumors swirling around. Obviously, panic can't catch on very quickly. And perhaps some of the moves that we saw yesterday, pretty brutal at times on the Monday morning session, have to do with that. And in fact, I spoke with the French finance minister, Bruno Le Maire, and his message to me was, just calm down. Let's take a look.
Calm down and just have a look at the reality. The reality is that the banks that you just mentioned, and I would say the French banking system, is not exposed to the Silicon Valley Bank is not exposed to the Silicon Valley Bank. So there is no links between the different situations. There is no specific concern for the French banks.
And that was the French Finance Minister, Bruno Le Maire, also insistent there are no links between the French banking system and that of the United States. There are two different stories. But he did talk about look at reality in the face, and that is exactly what investors are doing this morning. I guess the question going forward is whether this uneasiness essentially stays across the banking sector in Europe, or actually you start to see investors pick up specific areas where they perceive weakness.
Yeah, I mean, I would suggest this could definitely change their revenue model because A, they may have to pay depositors a lot more if they want to keep, of course, them happy. And at the same time, we could see central banks that don't raise as much rates, and that also hits their banking model. How unlucky, Maria, is the ECB that they have a decision this Thursday?
Francine, I mean, the timing of this, it's very particular. Remember, in the previous meeting, Madame Lagarde, she calibrated this hike on Thursday that is supposed to come on Thursday, 50 basis points, unless something very extraordinary happened. A lot of the ECB watchers that I spoke to yesterday were still betting that this 50 basis points hike is going to be delivered on Thursday, but there's a real debate now, which is very, very active in markets about the signaling going into May. Can you actually commit given the volatility that you see play out? And to me, I want to bring you two comments which are pretty relevant in that sense. One is the Spanish finance minister, Nadia Calviño, who told me at this point, when you look at the volatility that's playing out, everyone, the financial actors, the fiscal side, the monetary policy, they should all be prudent. We also spoke to Paolo Gentiloni. As you know, he's the head of economic affairs for the European Commission. He said on Thursday, the decision from the European Central Bank, a lot of it is expected, but going forward, they should stress this pledge that it really is data dependent. So perhaps not commit too much in this context of volatility.
Maria, thank you so much. Maria Tadeo, they're on the ECB, of course, for us from Brussels. Coming up, Circle Chief Executive Officer and co-founder Jeremy Allaire on crypto, stablecoin, and the SVB fallout. That interview is next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
Circle, the company behind the world's second largest stablecoin by volume, USD Coin, has seen turmoil amid the tech bank failures in the US, But the stablecoin has also recovered as regulators stepped in at failed bank signature. Now, the wild ride, however, raises the risk of increased regulatory scrutiny. Well, we are delighted now to be joined by the Circle Chief Executive Officer and co-founder, Jeremy Allaire. Jeremy, thank you so much for coming in. So how much, first of all, good morning, but how much damage did the DPEG cause to USD's reputation? And, you know, is it long-lasting damage?
Well, I mean, look, I think what's really notable about what we've seen over the past several days is that, you know, the narrative had been, how do we protect the banking system from crypto? And I think what's taken place here is a demonstration of how do we protect a stablecoin from the banking system itself. And we have long advocated for a full reserve model for digital dollars on the internet. And we've emphasized the risks of the fractional reserve banking system as something that backs that. And so we'll come back to, I know, the regulatory questions, but the important thing here is the result of this has been that, you know, we have been able to actually move the entirety of the reserves, which had already been essentially held in you know, Circle Reserve Fund with BlackRock, all short-term T-bills, that's about 80% of it, and the remainder with Bank of New York Mellon, to have, you know, the safest underlying dollar digital currency that's out there. And so we're actually coming out of this with an infrastructure, a dollar market infrastructure that's the safest in the world for transacting in the space.
And you flagged, talking of the reserves, you flagged that you had about $3.3 billion US worth of reserves at Silicon Valley Bank. Have you been able to access those? Have you been able to remove those? What's the update on those reserves?
That's exactly right. So, you know, we were able to access those yesterday, and I believe, if not everything, very close to everything was able to clear, and so we'll publish a kind of full update on that today. But that's exactly right. So, you know, we're in a place now where we have, I believe, the safest digital dollar on the internet, and that's really critical.
Have you done enough due diligence on a cross-reverse approach?
So, you know, we have said that we're working with a payments bank, and that's really for handling settlements and transactions, not a reserve bank. And so, you know, sort of money in transit coming in and out of the system, settlement banks are really critical. We'll have more announcements around those kinds of things soon, too.
Look, I mean, a lot of executives are going to be looking and asking their risk management teams whether they have the structures in place. There would be the argument that maybe you had some flaws in the risk management structure if you had that extent of reserves placed at SVB. Do you accept that?
I do not.
Do they need to be looked at again? Are you making any changes around risk management?
Yeah, so I don't accept that. I think that a lot of the people are asking questions, you know, which are really, you know, have regulators fallen down here? Have regulators of the commercial banking sector fallen down here? And similarly, I think there's legitimate questions that are being raised around, in a kind of very rapidly rising interest rate environment, as you looked at that $680 billion of uninsured deposits in these mid-sized banks and the kind of duration risk that was already embedded in their bond portfolios, was that something where the actual regulators were asleep at the wheel? And so there's a lot of questions as to that. When you have an A-rated bank that is durable, it's hard to see, especially when there's opacity in terms of the flows. The nice thing about digital assets is everything's visible and on-chain in real time, and so people can see exactly what's happening, and that's really key. But you can't see exactly what's happening inside of a bank.
I know, but you can't really. I mean, you know, if you look at Kraken, if you look at any of these banks, I mean, if there's a run on a bank or actually a chase for a deposit, it's every entity has a similar problem. So, you know, the fact that you're not making any more due diligence for partners means that you're pretty comfortable that going forward, the system will be okay, or that regulators are looking at it.
Well, so our view has been that if you want to have a dollar digital currency that is operating on the internet, that the right structure for that is a full reserve issuing model. And that full reserve model being supervised by prudential regulators like the Fed and Treasury. We've advocated for that. That is, in fact, what policymakers around the world are putting into model law. That's really key, because we don't like the fact that some portion of what backs a digital dollar is dependent on the embedded risks of fractional reserve banking. So we really need to move beyond that if we want to build a safer internet-based financial system.
Is there more that you're doing that can reinsure and assure your clients, your customers, around diversifying the stablecoin, putting other measures in place to ensure that you don't get the kind of DPEG that caused so much angst over the weekend?
I mean, you know, absolutely. And I think this gets into the discussion of, Are people moving from smaller and medium-sized banks to the G-SIBs? I mean, those are the kind of questions that everyone's asking, and that's obviously cascading across the markets by holding our reserves in 80% in U.S. T-bills, short-term T-bills, providing daily transparency of that through an SEC registered and supervised reserve fund with BlackRock. That's what we've been doing now for quite some time. That provides an enormous amount of assurance. And then obviously continuing our attestations, working with top assurance firms, and making sure that those reserves, the cash piece, are held in the kind of highest rated, lowest risk, cash custodians in the world, such as
But none
BNY
of that stopped the DPEG.
Okay, so trapped funds in a failed bank is entirely responsible for that. So obviously, what we want to make sure is that we are insulated from the risks of the fractional reserve banking system, which is continuing to cascade today, tomorrow, across many other actors.
Have U.S. regulators voiced any concerns about that with you?
About
the DPEG?
I mean,
have you heard from them?
We absolutely talk with all of our regulators. I think everyone wants to understand, are funds in a safe place? Yeah. How are the liquidity operations functioning? Are we meeting our various statutory obligations, which we are? And so those are really the kind of key things that people are focused on.
Binance, Orbi, some of your competitors, they've talked about the need, or at least the rationale for having a crypto bank. Do you align with that view? Would you be looking at some point for a banking license?
So we've made very clear that we would like to be chartered and supervised by prudential regulators such as the Federal Reserve, Treasury, or the OCC. We think that's critical. If you're going to build a digital dollar and you're going to build that on the internet and it's going to be accessible and usable as a financial market infrastructure, we believe we need to be kind of licensed and registered at that level. But those institutions, they need Congress to act. Congress needs to provide them with the statutes to enable an issuer such as ourselves to be regulated and supervised that way. And so I think this is really just going to drive more urgent calls for payment stablecoin legislation. We're seeing model law in the EU, UK coming. We're seeing that in many other jurisdictions. And obviously, I think this is going to drive that conversation further in the U.S.
Jeremy, because of the bank failures and the last 3 to 4 days, will you need additional funding in the next year or so?
Not at all. I mean, this doesn't have any impact on the company's sort of core finances. We're rapidly growing. We're profitable, cash flow generative, have a very strong, healthy balance sheet. And so our business is in a very strong position.
IPO plans?
I think we ultimately do want to be a publicly traded company. As you know, we worked on that and ultimately decided not to move forward with a particular path. But we believe that the accountability of being a public company is really critical, especially as a financial market infrastructure company. And so that's something that we certainly continue to want to explore.
Okay. Really appreciate your time. Thank you for coming to the studio here in London. Circle CEO and co-founder Jeremy Allaire. Thanks for joining us. Right, coming up, fire spreading as the fallout from the SVB collapse hits global markets. We're going to assess the damage. That is up next. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open, everyone. 54 minutes into the European trading day. You can see a little bit of relief. Look, let's see what the CPI print in the U.S. brings. And of course, treasuries, frankly, are all over the place. They were steady, and now they're moving a little bit. European stocks still gaining 0.3%. And this is on the back of hope that, of course, the Fed capitulates. And we'll see whether there's any indication of that a little bit later on, Tom.
Okay, yeah, and to unpack the market action 54 minutes into your trading session this Tuesday, let's bring in Bloomberg cross-asset markets reporter Justina Lee. Justina, the whipsawing, as Fran's saying, in these bond markets. Help us understand what is going on. Yields back up 20 basis points at the front end on the 2-year, 4.15.
Yeah, it's really pretty crazy. I remember last week when I went on TV, we were still talking about whether it's going to be a 25 basis point or 50 basis point hike at the Fed meeting this month. And now we're talking about whether it's going to be 25 or 0 or even a rate cut. And I think, people can really tell that the Fed is in a bind here because obviously now they're pretty concerned about the risk spreading through the banking sector. But at the same time, just a week ago, they were still thinking about how inflation hasn't really slowed meaningfully. And that's why today's CPI print is that important, because we're going to get a sign of whether, inflation truly is still too hot for the Fed to think about pausing tightening.
Justina, thank you so much. Justina Lee there with the very latest, of course, on some of this whipsaw that we saw in equities. I mean, the other story we need to watch out for is Credit Suisse. Credit Suisse shares have been hurt by a spiral of negative news in the past few years, putting them at 97% below their 2007 highs. Let's also check pre-market regional banks. So it's really the Armageddon-like bank equity story that we saw yesterday is not playing out today. We're actually seeing some of the regional banks, including First Republic, gaining 20%, Tom.
Yeah, in the bond markets, again, a lot of volatility, but at the front end of the 2-year, yields are up now, 17 basis points, 4.15 US 2-year. The 10-year at 3.57. Of course, we look ahead to that CPI print out of the US. You're also seeing yields higher across gilts, and there was money moving into German bonds, yields coming off at the front end, but not as pronounced as they were about 30 minutes ago, 2.65 on the German 2-year. In terms of your banking sector here in Europe, where the damage was really done yesterday, currently that sector is just range-bound, in fact, having been down 0.4%. Things have turned around a little bit for the banking sector of Europe. That is it for the European market open. Futures in the US pointed to gains of 0.6%. Stay with us. This is Bloomberg.
YouTube now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
There are risks remaining, right? And they're escalating right across the whole global financial system.
I'm sure there will be more financial aftershocks. It would be a serious mistake for the Federal Reserve not to remain focused on its objective of containing inflation.
We have inflation still above trend here, and that has to come down. And that means more hikes, not less hikes.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The hits just keep on coming for Credit Suisse. The bank says it found material weaknesses in its financial reporting since 2021, and client outflows continue. Critics sound off. Ken Griffin joins a small but vocal group of market participants warning the U.S. actions on SVB could lead to moral hazard. And U.S. CPI data later today may add a twist to the drama. Investors brace for another bumpy ride as we get the readout on inflation for the month of February. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, the focus will switch to consumer price index, the CPI inflation data out of the U.S. Will it be ignored by markets, or will it be a timely reminder of the inflation fight that still needs to be underway?
Yeah, I suppose a lot of it depends on what numbers we see at the release, right? If it's a big miss or a big beat, maybe that's more meaningful than just coming in line. We're expecting 6% year over year for the headline number, I think 5.5% for the core number. In any case, in terms of what we're looking at on futures today, up about 0.5%. But there has been so much volatility in this market that these numbers are all very much subject to change in the next 4.5 hours before the market opens. You can see the U.S. two-year yield right now adding 19 basis points to 4.16. And in a moment, I'll show you, we've just been up and down all around the shop, as you might say, in England, in jolly old England there. The U.S. 10-year yield at 3.57 right now, barely changed. So the front end of the curve moving a lot. And indeed, the long end is moving a lot as well, but the 10-year yield just absolutely unchanged right now. Bitcoin, very interesting, up about 0.4%, but getting back towards $25,000 right now at 24,340. What I think is really fascinating is what's driving the price moves. Of course, we have a show focused on crypto that airs at 1 p.m. New York time today. To me, it seems like when a lot of people are withdrawing Bitcoin from centralized exchanges, those exchanges have to transfer out of treasuries into the cryptocurrency, and that's part of the upward pressure on the price. Let's take a look at the two-year yield right now, because that is where you see massive volatility. So at one point, we were up above 4.20 on the two-year yield. At another point, we were down at 3.82. So it's been huge in terms of the swings that we're seeing. And right now, we're bouncing back again. But you see this volatility in bank stocks. You see this volatility in massive indexes as well. So big swings are what we're prepared for here in the U.S. today. What do you see, Anna, in Europe?
Yes, all over the shop is the phrase we use here in little old England, Matt. But it is entirely appropriate today because we are all over the shop when it comes to what stocks are doing here in Europe with the two-year yield, as Matt, you just highlighted. Certainly a lot of volatility there. So this is the picture across European equity markets, some weakness in London, some strength elsewhere. But the gains we are seeing, not entirely secure, it feels. We're kind of half and half divided between the sectors as to those going higher, those going lower. Not a great deal of conviction, it would seem, in it right now. Let's have a look at the European expression of some of that bond market story that Matt was just talking about. This is the German two-year yield. I picked out the German two-year, and we're seeing the yields dropping here at this particular time horizon. Further out the curve in Germany, we're seeing yields going higher. In the UK, we're seeing yields going higher across the curve. So things looking a lot less uniform when it comes to the bond market story right now, and things, as Matt was saying, looking volatile. This is the property sector, one sector that's doing really well here in Europe, up by 1.6% today, as we've seen the direction of travel for lower yields over the last couple of sessions, and those expectations coming in as to just how much hiking we are not going to see from global central banks. That, it seems, is being considered well by those companies that are exposed to that interest rate in the property sector. Volkswagen is down by 0.6%. The company's saying it's going to spend more than we previously thought when it comes to its capex around EVs, so that's something for the market to consider. And Credit Suisse down by 4%. So many news lines here. They're talking about material weakness in their reporting from 2001. They're also talking about outflows at the business, and more broadly, this news falling into a sector, Matt, a banking sector that is extremely nervous around SVB. We've seen CDS widening, a sign of nervousness around the banking sector here in Europe.
Yes, the SVB story continues to rattle around markets. A huge surprise. One bank that we're never surprised to hear bad news about is Credit Suisse. Bloomberg's finance reporter Tom Metcalf joins us with even more of that. What can you tell us, Tom, about what's going on now at Credit Suisse?
Well, yeah, a big surprise announcement today. Basically, their annual report came out, and one line in there, or some elements in there, about there's material reporting weaknesses for its 2022 and 2020-21 results. So look, that is a process thing. They're not saying, you know, the sort of fundamentals of those reporting is, or the results are wrong, but what they're saying is, you know, we haven't quite got our financial reporting right, which, as you can imagine, is pretty bad news if you're a bank.
And you can, yeah, I mean, I guess we had some sense that this might come, given the SEC's concerns around it, didn't we, Tom? But one thing we're also watching, of course, is IPO plans at CS First Boston. What can you tell us about how far advanced those plans are?
Yeah, a few more details coming out. So now it seems that about 20% of the equity is going to go to sort of senior leaders. Employees will get restricted stock units. And, you know, it's just it's taken shape, that unit. And obviously, you know, big challenge they have to sort of establish themselves as this, as they call it, a super boutique, a super advisory boutique. But yeah, starting to look like, you know, there'll be a lot of skin in the game for its top bankers at least.
All right, very interesting to hear more details about CS First Boston. Tom, thanks so much for joining us. Tom Metcalf there. Now let's get back to really the shocker that has run around markets the last couple of trading sessions. A small but vocal group is emerging as critics of the U.S. government's emergency backstop of the financial system after SVB's collapse. Billionaire Ken Griffin told the Financial Times the U.S. government shouldn't have intervened to protect all depositors at the bank. Meanwhile, former Treasury Secretary Larry Summers praised the actions taken.
The authorities over the weekend did what they needed to do. It was clear that if there wasn't assurance put behind deposits, both deposits in the failed institutions like SVB and deposits in other institutions, that you were going to have enormous chaos this week.
Janelle Bassick, our global finance correspondent, has the latest Wall Street response to the collapse of SVB, and there's a little bit, I guess, of a debate brewing here.
A huge debate brewing. You have the likes of Bill Ackman agreeing with Larry Summers, saying the government made the right actions, but then there's this large chorus also warning of moral hazard. That crew, as you said, includes Ken Griffin, who also believes that capitalism is at risk also. Capitalism is breaking down before our eyes, he told the Financial Times.
Dramatic.
Well, there's a lot of drama behind the story, Matt. And so you have the others, like the likes of Cliff Asness here, saying this creates moral hazard for depositors who no longer think about where they need to put their money. Carson Block of Muddy Waters has the same thing. This is particularly for corporate clients that are more required here to manage their risks. Jason Furman of Harvard Kennedy School, of course, prominent economist, also says that he's less worried about moral hazard, but more worried here about the idea that the system failed. There's this other dynamic also going on, this view, guys, that there is this kind of backdoor QE being created behind that Fed facility created because of holding the bonds at par. This idea that you're still holding 30 to 40 billion or more worth of kind of write-downs here that exist under the system. So are they pumping the system with more liquidity? Is this an inflationary impact just at the time you don't want to see it? So a lot of concerns about the distortions to the market that are created by what we've seen done over the weekend.
Okay. A lot of big voices then raising questions about what this means for markets, what it means for global capitalism. But what about whether we are heading for a major financial crisis? I know that Michael Burry of Big Short fame doesn't think so.
Yeah, he doesn't, and there's other people who have different views. You know, on one hand, you have Bill Ackman thinking more banks will fail. That's a pretty popular view out there, thinking that more banks will feel stress under these kind of tighter liquidity conditions. But like I said, was that liquidity just eased in a major enough way. On the other hand, you have Guggenheim's Ann Walsh, the CIO there, who believes that this was a bear moment, that this could have been a bear moment, that this was kind of early 2008 where there's a harbinger of more things to come. Remember, a lot of people are pointing to the fact that this is not the first liquidity-induced kind of crisis here. You think back to what happened in the pension funds in the UK just months ago, and you're seeing drips and drabs of unintended consequences. Most people would have told you that they didn't think that this was the canary in the coal mine, but there are concerns still under the market about what comes next.
And both people on both sides of the argument, I should say, are pointing out that, you know, money printer go burr again, right? Yeah, it's no longer clunk. It's back on. Sonali, thanks very much for that. We should mention that we're seeing a rebound in regional bank stocks in pre-market trading. So any of those that have taken huge hits like First Republic or Western Alliance are now seeing a bit of a bounce this morning. Let's get to the Fed response, or what we expect, especially after the big data that we're going to get. Fed Chair Powell's strategy to speed up the central bank's inflation-fighting efforts unraveled in the wake of SVB's collapse, with fears about financial stability or instability overshadowing today's CPI print. Kriti Gupta, our markets correspondent, joins us now for a preview of that data, and it could be a really big number.
It could be a really big number. Look, you're already seeing some of Wall Street kind of differ on what that number will be. Now, the economist estimates surveyed by Bloomberg are about 0.4% rise on a monthly basis, a yearly increase of 6%. Bloomberg Economics, on the other hand, our research arm coming out and saying, look, it could be even higher. And it really comes down to the components, because a lot of the kind of sticky parts of inflation have been that housing piece. We've started to see a deceleration in commodity prices. I believe we had a bet on this that you beat me on, but essentially
so far.
True, it could double peak. Anyways, oil prices coming down, food prices coming down, not really helping the end consumer, but housing and wages staying a little bit sticky. This time around, you're seeing calls that, look, in the last couple of months, utility prices, specifically in California, have gone up quite a bit. You've seen a lot of the kind of gas prices come up as well from that trough that we had seen in commodity prices. But you might be seeing a deceleration in housing finally. So there's a lot of moving parts here. And when it comes down to what the Federal Reserve is going to do, it's all about breadth. How broad is the inflation when you look at the basket?
So we'll focus in on the inflation picture, and usually we'd say this is going to be front and center for what the Fed does next, but we know that there's the SVB fallout that in some people's view needs to be factored in. Others say, actually, that's a different part of the Fed, and it shouldn't let that get in the way of monetary policy. What does all of this mean then for Fed pricing?
Well, you're looking at a terminal rate now priced in the market of about 5.1%, and that is very significant. That's why you're seeing such a dramatic move in yields as well. But Anna, I think the best way to describe it is to just look at the divergence you're seeing on Wall Street. If I can throw some numbers out at you, Morgan Stanley, for example, Citi still saying 50 basis points is in the cards. And you have the folks over at Evercore, JP Morgan saying, well, actually, we're going to go back to 25. Goldman, Barclays saying there's going to be no hike at all. It's going to be a pause altogether. For me, I think the highlight of all of this, all the Wall Street calls that kind of came in yesterday, pre-CPI, I might add, give it a couple hours, I'm sure some of the calls will change. Nomura saying a 25 basis point cut and an end to QT. To Sonali's point earlier, the idea that QE is kind of built into the system that the Fed and the FDIC have now created, there's an interesting talk about whether QT is really necessary at a time when you're trying to establish that financial stability, or at least reinstill confidence in the market. So I think that is going to start to become more and more part of the conversation going into the meeting next week.
Yeah, QT seems a long way off when they're just pumping out money to bail out depositors in big institutions like SVB. Kriti, thanks very much for that. Bloomberg's Kriti Gupta talking to us about what to expect from CPI and the Fed. Let's take a look at some of the stocks we're watching in the pre-market this morning. GitLab, which is, I don't even know if I can say that in the UK. Apparently Git is a very bad word there. Shares dropped 30% in post-market trading after forecasting revenue for the first quarter and full year that trailed analysts' estimates, so huge drop for GitLab. United Airlines warned it will post a surprise loss this quarter as it grapples with high labor costs, so you can see United down almost 6% in the pre-market. And then Standard & Poor's says Bungie will replace Signature Bank. This is not the video game maker connected to Halo or Call of Duty, but an agriculture company is going to replace Signature Bank in the S&P 500, and that gives it the requisite pop. Right now, 7% in the pre-market. And then finally, a court ruled that Uber, as well as DoorDash and Lyft and other such companies, can treat workers as independent contractors rather than employees under the California voter-backed initiative known as Prop 22. Anna?
Okay, lots to watch then when it comes to pre-market. Coming up on this program, we'll talk to Matteo Savary, BCA Research Chief Strategist. How much is he having to rethink his Fed expectations, or maybe not at all, based on the SVB fallout? We'll get his take. We'll also discuss the impact of SVB on crypto and on regulation. We will be joined by Liz Boyzon, who is a partner at Hogan Lovells. That regulation conversation coming up shortly. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Is important to you to have women in business? Are you trying to be a role model? And have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table. And in business particularly, because, you know, most consumers are women also.
Breaking news first.
Things begin to break. The chaos on Wall Street right now and around the world filtering through into European equity markets.
We don't see this as a systemic crisis. The banking system is safe.
Does the Fed have all the tools it needs to contain this problem?
I cannot believe that what's happening in the banking sector will not give the Fed pause.
The volatility has been nuts.
How much of this move is an overreaction?
There are additional dangers that need to be reviewed.
For the latest on the SVB collapse, keep it tuned to Bloomberg TV and radio.
Volatility has been nuts. This is Surveillance Early Edition. I'm Matt Miller here in New York with Anna Edwards out in London. We're looking at such a volatile market that things move along more quickly than we can update headlines. This is the 2-year yield, and what we had seen for a moment was the biggest 4-day drop since Black Monday in 1987. But now the 2-year yield is climbing again. So it was only actually down for 3 out of the last 4 sessions. Still, that 3-day drop is the biggest that we've seen since Black Monday as well. So it goes back a long way, as you can see by this chart, fantastically put together by Daniel Curtis for us in London. Just incredible volatility and unbelievable to watch a 2-year yield go from, I think, more than 5% on Wednesday to 382 for a moment early this morning. Justina Lee joins us, Bloomberg markets reporter, to talk about what's driving this roller coaster ride. Justina, it's understandable if it goes in one direction, but why up and down and up again?
Yeah, I think that just really points to the whipsaw in sentiment. I mean, I remember last week before SVB, we were still talking about whether it's going to be a 25 or 50 basis point hike from the Fed this month. And now we're talking about 25 or even 0 or even a cut. And I think it's a sign that, markets kind of see that the Fed doesn't really have a great risk appetite right now for more instability in the banking sector. And maybe they're more worried about that. But it's easy to kind of forget that. I mean, before all of this, we were all thinking about how the data has simply been too hot for comfort for the Federal Reserve. And that's why today's CPI is really important. And I think that's why you're kind of seeing yields bouncing back up again.
Okay, so it's a complex picture on bond markets. It looks less uniform than it did over the last couple of days, Justina, as if there's more nuance or people just more confused, maybe, as to where we go next. Justina, what messages are you taking from stocks? US futures look slightly more positive. European stocks, fairly flat, despite heavy selling yesterday. The DAX down by more than 3% in session yesterday.
Yeah, I think yesterday's moves were quite bond-driven. I mean, we saw, tech stocks coming back up, and that's usually because they're very sensitive to what happens in the bond market. And, at the same time, we saw widespread risk aversion. Value stocks got slammed, small cap stocks got slammed. And I think today you're kind of seeing a lot less of that divergence. And that's another sign the markets are kind of calming down today and kind of shifting the narrative back to what happens with monetary policy.
Okay, Justina, thanks very much. Bloomberg's Justina Lee with the latest on markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. This is Bloomberg.
Breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as United Nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Let's keep you up to date now with news from around the world. Here's the first word. Chinese President Xi Jinping and Ukraine's Volodymyr Zelensky are said to be planning a video call in what would be their first conversation since Russia's invasion. The Wall Street Journal reported it could come after Xi visits Moscow, a trip which could come next week. President Biden, meanwhile, says he expects to speak with China's leader soon himself once the government in Beijing returns to work following the National People's Congress. So a lot of meetings ahead. The U.S. system of federal home loan banks is ramping up the amount of cash it has available to deploy as the failure of several U.S. lenders stokes expectations that more regional lenders will need to tap it for funds. The FHLB system, a key source of cash for regional lenders, raised $88.7 billion for the sale of short-term notes, exceeding the $64 billion initially planned. Fannie Mae has postponed the sale of more than $500 million of mortgage-linked bonds sold by Nomura and Morgan Stanley. Bloomberg has learned Fannie Mae alerted investors that the deal, which is a $542 million credit risk transfer security, would be delayed, citing market conditions. The securities are riskier than regular Fannie Mae mortgage bonds because they are among the first to take losses when homeowners fail to make payments. U.S. prosecutors are looking into chat group conversations among prominent trading firms about a potential bailout of the Terra USD stablecoin project. Manhattan federal prosecutors are probing conversations on Telegram among employees at Jump, Jane Street, and the now bankrupt FTX affiliate Alameda Research last May, and whether possible market manipulation was involved. Anna?
Coming up on the program then, Mathieu Savary joins us, BCA Research Chief Strategist. As the fallout from the Silicon Valley Bank fiasco, is that having an impact on your Fed calls? Or do you think inflation rather than recession remains the biggest risk for 2023? We'll ask Mathieu. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The hits just keep on coming for Credit Suisse. The bank says it found material weaknesses in its financial reporting and client outflows continue. Critics sound off. Ken Griffin joins a small but vocal group of market participants warning the U.S. actions on SVB could lead to moral hazard. And U.S. CPI data later today may add a twist to the drama. Investors brace for another bumpy ride as we get the readout on inflation for the month of February. I'm Anna Edwards in London with Matt Miller in New York. U.S. futures point a little bit higher, but such is the volatility in fixed income markets, Matt, that I'm not sure anyone's got a great deal of short-term conviction.
Yeah, absolutely. And we're going to get, of course, that CPI print, something that has, over the last year, very much moved markets at 8:30. So that an hour before the market open, we could see these numbers change drastically. S&P futures right now about 1/3%. In the cash trade, we closed down just a bit yesterday, about 1 or 0.2% off the levels that we saw in the close on Friday. So there hasn't really been a lot of movement on the broader index over the last couple of trading sessions, even though, of course, last week there was a lot to the downside. And, of course, bank stocks have been dragging on indexes around the world. The U.S. 2-year yield currently up 22 basis points. So the price is falling and the yield is rising once again. This after we saw the yield absolutely collapse in the previous 3 trading sessions. We went from 5%, more than 5%, down to less than 4%, but now we're climbing up to about 4.20 at the front end of the curve. The 10-year yield not moving much at all. Right now down almost 2 basis points at 3.59, but remember the 10-year also was up over 4% last week, so it's moved pretty quickly for a fixed income instrument like this. Bitcoin also rising a bit right now, $24,277, and it rose in yesterday's session as well, possibly as more investors pull the cryptocurrency off of centralized exchanges, forcing those exchanges to then sell their treasuries or whatever they had invested in with the Bitcoin and buy crypto instead. Take a look at some of the pre-market movers. There's a lot going on under the hood this morning. First of all, in terms of the banks, a ton of the banks that got hit very hard. I mean, First Republic has lost 3/4 of its value over the past 3 trading sessions, getting a little bit of a bounce now in the pre-market. And the same is true for these. PacWest, Western Alliance, Schwab even taking a big hit and now rebounding a bit. Then in terms of non-bank movers, GitLab is one of those. It dropped more than 30% in the pre-market, down after forecasting revenue for the full year that missed analyst estimates. United Airlines is another one getting hit hard in the pre-market, warning that it will post a surprise loss this quarter as it grapples with the high cost of labor. So maybe plane ticket prices won't go down. Standard & Poor's added Bungie to this S&P 500 to replace Signature Bank, which of course was seized by the FDIC and closed on Sunday. So that gives it a requisite pop in the pre-market right now, about 7%. And then watch Uber or Lyft or DoorDash or any of those companies that treat employees as contractors. They are now allowed to do that according to a California appeals court backing the California voter-backed Prop 22 initiative, and shareholders like the look of that. Uber, for example, up more than 4%. Anna, what do you see in Europe?
Yeah, well, just as I've been standing here listening to you there, Matt, we've seen the European stocks tick down into red. This was green just a few moments ago, but now down into negative territory on the Stocks Europe 600. Yesterday, we saw losses of more than 3% on the Xetra DAX. We saw other European equity markets really coming under pressure, possibly because we've seen such strength in European stocks, and specifically around banking stocks since the start of this year. So some of that year-to-date enthusiasm in banks specifically, but more broadly as well for European stocks, being unwound over the last couple of days or so. Credit Suisse, it's part of that narrative, but then goes beyond that, of course, because that stock getting some extra movement to the downside as a result of some news lines coming out of the company saying that they found material weaknesses in terms of their financial reporting. It's more of a process story, but adding to nervousness around the market and around the banking sector, of course. They also talk about outflows today, news lines there. Volkswagen down by 2.5% as the car maker says it's going to invest more than had been previously thought in EVs. And the German two-year yield, Matt was just talking about what's going on the US side, and we're seeing some convergence really around what's going on in bond markets. We see some selling of the 2 years, some selling across the board, actually, across European debt markets, and we see those yields then rising just a little. And that now, this morning, we seem to have coalesced around that being the direction of travel for the moment, at least, as we wait for that CPI data, Matt.
Yeah, absolutely. Looking forward to that at 8:30 Wall Street time. Joining us now is Mathieu Savary, Chief European Investment Strategist at BCA Research. Mathieu, thanks so much for joining us after the volatility of the last 3 trading sessions since really the bank run began at Silicon Valley. Has anything changed, in your opinion, in terms of the financial system? Have conditions gotten tighter? Are you less concerned about rate rises from the Fed, the BOE, the ECB?
Well, yes, things have definitely changed. It is very possible, even likely, that the SVB problem will remain contained to SVB. There are some very specific facts that suggest so. However, financial conditions have tightened significantly. We're talking about financial condition indexes that have jumped, credit spreads that have done the same thing, the volatility index for the bond market that is much higher. And what is really concerning me is the fact that cross-currency basis swap spreads are widening again, which usually is a sign that there are underlying tension in the market. So this is definitely changing the equation quite a bit at this point in time when it comes to the outlook for rates. Specifically, when it comes to the Fed, it looks like a pause now is very, very likely at the upcoming meeting. The ECB is likely to increase interest rate at its also upcoming meeting, but then become much more careful about how it's going to communicate what it will do afterward.
You know, we're going to get, obviously, CPI in just about 3 hours from now, which will show us the latest snapshot of inflation. If it's bad, the Fed is going to want to continue to tighten, I imagine, especially since financial conditions, you and I look at the Bloomberg FCON Go or Goldman Sachs or Citi or some such financial conditions index. But the Fed, as Emily Graffio from Bloomberg News recently wrote, looks at much more simplistic measures, like mortgage rates, for instance, which have come down pretty dramatically as a result of this. So even though we feel financial conditions have tightened, it may look to the Fed like they've loosened a little bit, and if inflation is high, why wouldn't they continue to raise rates at a pace of 25 or 50 basis points?
Well, the key word was pause, in the sense that here it's an opportunity to reassess the situation. You're absolutely right that if inflation remains strong, the Fed will restart hiking interest rate. At the end of the day, all the programs that have been put in place around SVB, Signature, Bank, and so on, have been put in place to give the Fed the option to keep increasing interest rate if the economy demands it. So that's why I think it is way too early to call the end of the interest rate increases in the US or even in Europe, and that instead what we're seeing is a moment for the Fed to pause, think, assess whether or not there are deeper damages to the banking system and the economy at large from the SVB crisis. But ultimately, the Fed's decision on a few months basis will be guided by inflation, by the labor market. And right now, they don't really send a signal that the Fed needs to completely halt its interest rate increases.
Okay, so Mathieu, if we do see a pause from the Fed, you think then we shouldn't interpret that as the end necessarily of the hiking cycle? I was drawn to some research, Capital Economics, saying that they draw inspiration, I suppose, from the LDI crisis in the UK, saying that yes, the BOE used its balance sheet to ease the liquidity issues in the short term, but then subsequently went back to raising interest rates. I mean, could we see something similar then from the Fed?
Yes, absolutely. What we are seeing, this LDI crisis, the SVB crisis, the fact that we're seeing financial accidents is symptomatic of the reality that the Fed and other central banks have tightened monetary condition considerably over the course of 2022. And when financial conditions, monetary conditions are becoming tight, we tend to see financial accidents pop up around the system. And that's exactly what we're seeing right now. But those financial accidents, if they remain contained, if they remain localized, and they can be kind of ring-fenced, they will not preempt central banks from fighting inflation further, because at the end of the day, their number one concern remains right now that inflation becomes entrenched, inflation expectation gets unmoored, and that's what they really worry about.
What do you make of what we've seen in European banks, Mathieu, over recent days? Real weakness across European, the banking sector. It's a function of a reassessment of how high rates go, what that does to margins for the banking sector.
So I am not worried about the European banking system. I don't think there's a crisis there. When it comes to, again, the specific of SVB, there was deposit outflows taking place from a bit because all those startups were pulling on their cash right now. European deposits are still growing. Now, that doesn't mean that this correction, this pullback wasn't warranted. European banks had a very substantial run lately, and the reality is that they were already facing some headwinds. The ECB had tightened considerably. We had seen M1, so money supply growth, really slow and in fact start to contract in Europe. Credit flows for households and corporations had really collapsed. Credit standards have become much tighter, credit demand much weaker. All of that historically lead to lower credit growth and lower EPS for the banks and for the financials in general. And on top of it, the reality is that monetary policy acts with a lag. So we are seeing those signs that monetary policy is already starting to affect credit dynamics in Europe. And this is despite the fact that we haven't seen the bulk of the impact. So I think, yes, we could see some downside to European banks, but that's more related to the earnings side caused by the tightening in monetary conditions.
Mathieu, thank you very much. Mathieu Savary of BCA Research, thanks for bringing us your insights. Coming up on the program, we'll discuss the impact of SVB on the regulatory environment and on crypto. We will be joined by Liz Boysen, who is a partner at Hogan Lovells, can bring us her expertise shortly. This is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
We've made very clear that we would like to be chartered and supervised by prudential regulators such as the Federal Reserve, Treasury, or the OCC. We think that's critical. If you're going to build a digital dollar and you're going to build that on the internet and it's going to be accessible and usable as a financial market infrastructure, we believe we need to be kind of licensed and registered at that level. But those institutions, they need Congress to act. Congress needs to provide them with the statutes to enable an issuer such as ourselves to be regulated and supervised that way.
And that was Jeremy Allaire, the CEO of stablecoin issuer Circle, speaking earlier on Bloomberg Television. Liz Boysen, partner at Hogan Lovells, joins us now from Washington. Liz advises companies and financial institutions in the payments and crypto spaces on financial regulatory compliance and enforcement matters. And Liz, I wonder how much your concerns have changed since the SVB meltdown that we saw last week. Circle, for example, had, I think, $3 billion at SVB. Now, thanks to the Fed, the FDIC, and the Treasury, they're going to be able to get all of that back. No more worry about insured levels of deposits. Everything is backed by the full faith and credit of the U.S. government. Does it matter?
Yeah, that's a great question. There's a really limited opportunity here for moral hazard. No one knows how long this short-term funding would last, and so limited opportunity for gamesmanship. For crypto or other companies that did keep their funds at the banks that have been backstopped, it obviously makes a world of difference. And generally, banks where they primarily had commercial deposits in excess of FDIC insurance levels, it really made a world of difference to institutions like that.
What about regulation now? I mean, we had expected stablecoins to be some of the regulation, some of the low-hanging fruit that this Congress would be able to pick, but it doesn't seem like they're really in a hurry to do it. Are we going to get any stablecoin regulation this year?
So there's no reading the tea leaves on whether this will accelerate or in any way delay legislation that otherwise has been in progress. It may inform the contours of what that legislation looks like. For instance, stablecoins being backed by certain types of assets and where those assets are kept. We've already seen the SEC act on custody rules and designate what is and is not a qualified custodian for crypto assets. I think in the stablecoin realm, it would be reasonable to require a certain distribution of fiat assets that back a stablecoin. So there may be more of a reach into the substantive world that becomes part of any stablecoin legislation.
Liz, good morning to you. So away from the specifics around crypto regulation, more broadly on the regulatory front, do you look back to 2018 and the introduction of the Economic Growth Regulatory Relief Consumer Protection Act that came into law in the US that freed mid-sized banks such as SVB from some of the more strict post-crisis regulation? Do you look back on that and draw a link between what we're seeing at SVB and that law?
It's really early to tell if it was some change in regulation that spurred that. What is for sure is that it was near-term and specifically short-term interest rates by the Federal Reserve being hiked up that led to a really, proximate cause situation here. Whether it was a specific regulation or market intervention that caused it, I don't think that's entirely clear, but the one thing that is for sure is when interest rates go up, the business of running a bank becomes a great deal more expensive. And I think there will be some regulatory inquiries into exactly what happened at Silvergate, those directors, officers, especially around what they did on last week's capital raise, whether there were any misstatements, any potential lulling of the market. Those will be examined closely, but it will be at the institutions specifically that were put under receivership first. I don't think there'll be a more comprehensive look at the banking sector and the effect of that type of regulation just yet.
Okay, so you don't think that this will trigger some sort of review of the size of institutions that face the toughest regulation in the US?
If anything, I think this is a indication that regulation and a lot of the post-Dodd-Frank reforms worked. And thank goodness there was this kind of regulatory intervention and market intervention available. A lot of my friends who did that kind of hard work in the government, their work has paid off, that these kind of facilities became available. What may come is some sort of indication to banks that they should be diversifying among retail and commercial customers, whether the business of being a commercial or merchant bank is a thing of the past. I don't think that's the case, but it certainly will lead to a closer look at those institutions.
Liz, great to get your insight. Thank you so much for joining us this morning. Liz Boysen, there, a partner at Hogan Lovells, talking to us about the potential for regulation in the crypto space and what's changed since the blow-up of Silicon Valley Bank. Be sure to catch, by the way, Bloomberg Crypto today at 1 p.m. New York time, 5 p.m. in London. It's our weekly show that covers the people, transactions, and technology shaping the world of decentralized finance, and Liz is one of those people. So great to have her voice. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. We get the U.S. CPI printout at 8:30 a.m. New York time today. The data could show robust readings for both headline and core CPI. Michael McKee, Bloomberg International Economics and Policy Correspondent, joins us now for a preview. So even after the collapse of SVB, we still could have an inflation problem on our hands.
We still probably do have an inflation problem. Remember when that mattered to people in the markets? Yes. It's like only yesterday or the day before, maybe. But yeah, the good news, bad news is that inflation is slowing. The question is, how fast is it slowing? The Cleveland Fed puts out a nowcast on CPI that gets good reviews because it suggests the direction and magnitude of the CPI report, and it is showing, and it has been for a while, that inflation continues to drop. And note on the right-hand side there, what you're seeing in this chart is that the Cleveland Fed's nowcast has come in below, the CPI's come in below the Cleveland Fed. So if we're looking for some more good news, maybe that is a potential good omen if that trend continues. Here's what we are expecting: a 0.4 increase in the CPI for the month of February, and that would leave us at a 6% rate. So a significant drop from where we were, but still high. The core 5.5% after a 0.4 increase. Anything more than that is going to set off a debate about what the Fed should do post-banking crisis. We hope it's post-banking crisis. And we're already seeing a lot of people who are putting out their forecasts for what the Fed's going to do.
Yes.
Which, Anna, I don't understand. Why wouldn't you wait till 8:30 this morning and just make your prediction?
Maybe you see value in being first, Micah. I'm not sure. But we've got a wide range, haven't we? The range now for the meeting this month is from a 25 basis point cut, I think, at Nomura, to a 50 basis point hike still at Morgan Stanley.
Yeah, I think the 50 basis point hike is probably off the table at this point. This is a Fed that likes to do risk management, and they are going to want to perhaps be as careful as possible. They do want to raise rates, so we can sort of expect them to do that. You know, the most important number probably today is Jay Powell's favorite indicator, and that is the core rate ex housing. We'll see if that continues to go down. It's been going down more in the CPI than it has been in the PCE, the Fed's favorite inflation indicator. So if we see that fall again, then maybe 25 is what we're going to get.
Yeah, the Bloomberg Economics preview suggests that core services number, excluding housing, will be crucial. So we'll watch that because Mike told us to. Bloomberg's Mike McKee joining us there with the latest on CPI. That is it for the early edition. Surveillance is up next with Tom, John, and Lisa. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
There's certainly a lot of uncertainty, a lot of fear. It's showing up in the bank stocks.
Yes, you are going to see a lot of gyrations in the market because investors are nervous.
It's another source of volatility in a highly volatile market. This is not a great backdrop to invest.
You're not seeing a meltdown in the equity market. You're not really seeing broader risks of a contagion in all markets.
I don't think this is going to lead to a recession. I'm still in the soft landing camp.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a move in the last 24 hours. Live from New York City this morning. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Futures positive 0.4% on the S&P. A little bit later this morning, 8:30 Eastern Time. CPI in America. Tom, we have to talk about this. That is the biggest reappraisal of Fed policy in a single 24 hours, I think potentially, TK, we've ever seen.
I think you've really got to go back to McChesney Martin, the independence of the Fed in 1952, to begin to get historical perspective here. You can go back to 98. I'm hearing that a lot, John, in the last 24 hours. People alluding not to 08, but to 98, which was a different set of cards. What people want to know this morning, 8:30, John, maybe. Maybe they want to know inflation. I want to know where 5 or 6 banks are. I've been watching Credit Suisse tick by tick this morning. And what people really want to know of all walks of life, including our sophisticated audience, should I move my money?
That
We're
question's
still there.
being asked.
We're still there.
Still being asked. So let's go through it piece by piece. Credit Suisse is lower this morning by 4.5%. We'll talk about that story a little bit later. 215, lower the session, 212, just off those levels right now. First Republic, absolutely battered in the last couple of days. That stock is bouncing just a little bit, up by a little more than 20%. But the move in a 2-year yield yesterday, we have gone from north of 5% to below 4%, all in 3 days. Just unbelievable. Back above 4% right now. We've got a 25 basis point move higher on our hands on a 2-year. And let's go through it bank by bank. I've got Goldman, Wells Fargo, Barclays, and others looking for a pause. Dan Iverson of PIMCO talking to team here at Bloomberg yesterday, suggesting that maybe the Fed pauses in March. Nomura going one step further. Can I share this quote with you from the team at Nomura? In reaction to looming financial stability risks, we now expect the Fed to cut rates in 25 basis point increments in the March FOMC meeting. They go one further than that, Lisa. They said, we also expect the Fed to stop QT at the meeting next week.
Yeah, this was shocking to me because it raises this issue of, have we really defeated inflation? Can they really reverse policy wholesale in order to prevent more distress? And this, to me, is the ultimate question of the morning. If an asteroid were facing this Earth, would the central banks just print money? At what point have we run out of ammunition to combat problems with lowering rates and buying bonds if inflation is still a problem and still something that central banks have to fight?
The estimate this morning is for CPI headline year over year to come in at about 6%. Core month over month, which is the figure Tom Wall Street is very focused on, 0.4%, in line with the 0.4% in a previous month.
It's the inflation move there. I mean, what we're going to have to see is off the service sector, which Mike will break down on, is do we see any in this vector, this idea of a trend, a point, a thrust of disinflation? I really can't say enough of how Mr. Powell right now needs help and assistance from the data. Talk about data dependent. This is a whole new character to data dependency we've never seen.
The data's coming in a couple of hours' time. Lisa will go through the day ahead in just a moment. Your equity market set up as follows on the S&P 500. Positive by 0.4% on the S&P. Yields are a little bit higher by 3 or 4 basis points on a US 10-year, 360.92. The move over the last 3 days has been absolutely phenomenal. Euro dollar negative 0.2% here, Lisa. Euro dollar right now 107.11.
All right, 8:30 a.m. What is going to be the biggest pain trade? I'm trying to get my head around that because right now this market is inflicting the most pain on the most market participants I could possibly imagine. 8:30 a.m. we do get February U.S. CPI at a time when a lot of people expect inflation to remain hot in the U.S. I'm looking at core inflation. The expectation is it will dip from 5.6% to 5.5%. This is stripping out the more volatile energy and food sectors. If it remains hot, what does the Fed do? What does the market do at a time where it's moved ahead of any Fed rhetoric and just price them out of the market almost for the rest of the year in terms of rate hikes? Today, we do hear from EU finance ministers who are gathering for day 2 in Brussels, discussing the economy. This is just 2 days ahead of the ECB policy decision. Talk about agony, given some of the volatility we've seen. The 2-year yield absolutely cratering, also in sympathy with what we're seeing over in the U.S. Again, does this make sense? Does a bank or a couple blanks that are sort of on the peripheries, largely, not necessarily for Silicon Valley, having issues mean that globally, Fed rates, ECB rates are all on pause and headed downward? And at 5:30 p.m., we do hear from Fed Governor Michelle Bowman, which is sort of odd because it is the quiet period, but she's talking about innovation in the banking system in Honolulu. I think we all would want to go talk about monetary policy in Honolulu. Does she talk about anything with respect to financial stability risks, John? People are going to be parsing through any indication that the Fed could give that they really are possibly going to pause at a time where inflation still is the preeminent concern.
Given it's the quiet period, she shouldn't be talking about anything related to monetary policy, but I guess we'll see. Priya Misra joins us now of TD Securities. Priya, this market screams the Fed is done. Is the Fed done?
I don't think so. I mean, I think the Fed is committed to inflation. Inflation is still hot. I would say the consumer is still hot. Now, the market's forward-looking. I think the market is putting higher odds of a hard landing. We've been in the hard landing camp. I think this accelerates it. But I think for next week, they go another 25. I do think the bar for 50 is very high. So we're looking for a 0.5 today on core CPI. I don't think that moves the needle either. I think they go 25. They put a pretty big bazooka in place with that BTFP program on Sunday. I think they're going to point to that. This was morphing. This had a risk on Sunday. I was worried that this is morphing from a liquidity crisis to a capital crisis. The Fed has put a pretty huge facility in place. If it's accessed, and it's a big if, but I do think it's going to get access, I think we stem the capital concerns.
Priya, so you have been so successful on price up, yield down on your call to load the boat on the 10-year yield. There's a rumor you may become a minority investor in the Toronto Maple Leafs. I don't want you to game the Fed right now. I want you to talk about what you do when you are so fortunate with the crisis move. Do you tactically go to cash? Do you tactically pull in duration? What do you do after such a successful set of trading days?
I mean, I think you take some chips off the table. You know, the economy is still strong. This crisis is still unfolding. I took half of our position off because it was a huge move, and I don't think the Fed is done. But I think you want to be liquid. You want to also keep an eye on a lot of stress indicators, the funding markets. You know, how is this? Because capital, you know, the moment it becomes a capital issue, I think now we're looking at Congress. So I'm a lot more negative if this morphs into a capital issue. I was very comforted by what the Fed did. So I think you're supposed to take some of those risks off. You're supposed to be in liquid assets, so you don't have to do any fire sales. I think what got SVB in trouble was they had to go out and sell very safe assets, but still, duration risk is real. So I think keeping some cash here, you're earning, potentially next week we think you're going to earn 5% on cash. It's attractive when it's highly illiquid, when you may have liquidity needs. I think you're supposed to keep risk light and then keep an eye out for opportunities. If the front end gets repriced even further, I would be tempted to go short. I think the Fed is going to be in, really between a rock and a hard place. Inflation's going to be high, and they're going to find it very hard, I think, even to pause, let alone cut.
Priya, a lot of people are coming out and saying, yes, but what we're seeing is a Fed that typically raises rates until something breaks, and it seems like something is breaking. Yes, we've had bank failures, but we also are seeing volatility, the likes of which we have not seen in 40 years. I'm looking right now also, even just at the implied volatility of the Bank of America Move Index, surging to the highest level since 2009. At what point, just the speed of these moves in benchmark rates, is that something breaking in and of itself in market functioning?
So I do look at different measures of market functioning. I think volatility is not great, but when the Fed is hiking, financial conditions tighten. I think the Fed always wants, not a disorderly tightening in financial conditions. We're getting that disorderly tightening right now. I do think they're going to watch, a few more bank failures. I think the Fed stops. But I do think if they are able to put facilities in place, which the banks access, that stigma, I do think the Fed needs to come out and say there is no stigma, or the recourse to other collateral. If you're pledging treasuries and agency MBS, that's what that facility is there for. It's to prevent banks from having to sell. I think if they're able to sell that facility, maybe that facility needs a PR department, and we can prevent some of the fire sales, the capital, the realized capital losses. I think the issue is that we knew that there were these unrealized losses. It's when you have to realize it, go out to the market that's very skittish and try and raise capital, that's when the problems begin. So I agree it's very volatile, but this facility is in place. I think what the FDIC did is huge. They insured, uninsured depositors are getting all their money back. I think, we need some stability in the market, I agree, but I think for the Fed to actually pause or cut, it's going to send a pretty negative signal. That what do they see? Do they see this facility not working? I think we're all watching for that Thursday evening, the balance sheet result when that comes out from the Fed. I do think you're going to see access, and that's going to tell you that the Fed is putting, I guess, facilities in place to prevent the liquidity crisis from becoming worse. And at that point, I think volatility does subside. The market always overdoes things because we have positions on and then you have to take it off or you get stopped out. But I think you take a step back and the economy is still strong. If we can, it's been a week, it's been actually 3 days. If the Fed can come in and provide these facilities and we can stop these fire sales, I think we can all calm down a little bit.
Priya, thank you for that. Priya Misra there of TD Securities. To Priya's point, Tom, it's been 3 days. So all these calls on the Federal Reserve, I get it. You've got to make a call. Maybe you've got to reassess things in light of what's happening in markets as well. But Tom, all these calls, where are we in a week's time? Where are we in 2 days?
We don't know. This is what's known as uncertainty, where you don't even have a set of outcomes. You have no outcomes. You're literally, to use the phrase, flying blind. What I would suggest is you look at the screen, and the summation statistic for me is how restrictive we've become with all these gyrations. Looking at the Bloomberg Financial Conditions Index, Jerome Powell is looking at I'll let an adverb come in here from our guests.
Sure.
A highly restrictive or super restrictive market. That was not the case 4 days ago.
This conversation is going to continue. We'll catch up with Phil Camporelli, portfolio manager at JP Morgan Asset Management, a little bit later this morning in the next hour. I want to whip through the price action for you. If you are just tuning in, your equity market is positive on the S&P by about 0.5%. If you'd like to know where a couple of names are, First Republic is higher by a little more than 20% in the pre-market after getting absolutely battered in the last few days. Credit Suisse want to watch, down 4%, down again over in Switzerland, 216 on Credit Suisse. And in the bond market, yields aggressively lower the last couple of days, higher this morning by about 3 basis points. Your 10-year 360.73.
with news from around the world. With the first word, I'm Lisa Mateo. Chinese President Xi Jinping and Ukraine's Volodymyr Zelensky are said to be planning a video call in what would be their first conversation since Russia's invasion. The Wall Street Journal reported it could come after Xi visits Moscow, a trip which may happen next week. President Biden, meanwhile, says he expects to speak with China's leader soon once the government in Beijing returns to work following the National People's Congress. The U.S. system of federal home loan banks is ramping up the amount of cash it has available to deploy as a failure of several U.S. lenders sparks expectations that more regional lenders will need to tap it for funds. The FHLB system, a key source of cash for regional lenders, raised $88.7 billion through the sale of short-term notes exceeding the $64 billion initially planned. Fannie Mae has postponed the sale of more than $500 million of mortgage-linked bonds sold by Nomura and Morgan Stanley. Now, Bloomberg has learned Fannie Mae alerted investors that the deal, a $542 million credit risk transfer security, would be delayed, citing market conditions. Securities are riskier than regular Fannie Mae mortgage bonds because they're among the first to take losses when homeowners fail to make payments. U.S. prosecutors are looking into chat group conversations among prominent trading firms about a potential bailout of the Terra USD stablecoin project. Manhattan federal prosecutors are probing conversations on Telegram among employees at Jump, Jane Street, and the now bankrupt FTX affiliate Alameda Research last May, and whether possible market manipulation was involved. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you, we will not stop at this. We'll do whatever is needed. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
The President of the United States there, live from New York City this morning. Good morning to you all. After that address, and after what we heard Sunday evening from officials, the Treasury, the Fed, the FDIC, a lot of people in this market thought we might get a bounce in some of these small regionals, the banks. First Republic was lower on the day by 60% plus, Western Alliance was down by almost 50%. Comerica, KeyCorp, both down about 27%. Lisa, I think a lot of people found that surprising. This morning, you do get a bounce, finally, on Tuesday by more than 20%. But what was yesterday about?
Well, I think that was the reason why people got very nervous, and that was part of the move that we saw in the two-year yield. If what the Federal Reserve and what the FDIC did was not enough to stave some of the panic, what would be? This morning, however, I do wonder if we see the whipsaw in the other direction, given that Comerica shares up more than 10%. Western Alliance shares up almost 20%. PacWest shares also absolutely surging, I believe more than 30%. So how much do you get this sort of sense of relief today, just delay today?
We say we're data dependent, Tom. Dependent on what data? Dependent on the prices of those names, or dependent on the prices that we get at 8:30 Eastern Time in CPI?
You're going to be careful with the data dependency there. To me, it's two separate issues now. Clearly, the financial part takes predominance over the economic part, but are they linked? Yes, they're linked. I'm sorry, there seems to be a belief that we've escaped flow angst of Thursday, Friday, Monday. I don't buy it for a minute. People have these things, and they're
game changer.
Them. I at all levels, and my frame of mind here is, as John, you've been doing, we've got to follow these stocks that have the interior pulse of that flow angst.
Dan Iverson, PIMCO, speaking to the team here at Bloomberg yesterday, said this could be a multi-month process, Tom. Not a couple of days, could be a multi-month process to adjust to some of this.
Right now, we're going to take a different perspective here. Magnus Billing joining us. He's the Chief Executive Officer of Sweden's Electa, and we're thrilled he could join us this morning here with perspective on the American banks and with perspective on the pension responsibilities in his Sweden, across Europe, and frankly, worldwide. Magnus, the path is this. October of last year, a small matter of a busted sure thing in the United Kingdom, a bailout by the Bank of England, literally in hours. What we've all observed over the last 4 days, and we look at Sweden as the bastion. What are the shadows within the Swedish pension system right now? Is it pricing commercial real estate? Is it different nuances of European banking? What are the shadows you confront this morning?
Well, good morning. Thank you for having me. I think, first of all, that the Swedish pension system is very robust. It's more robust than it's been in the last 10, 15 years. But having said that, obviously, end of the day, it's a lot about liquidity when the psychology kicks in into the market space. And I think the issue that you brought up about the UK event that took place last year, and also what we see now in the past week or so, is a lot of liquidity, psychology around the liquidity, and the easiness one can move capital today with the digital development that we've seen in the past number of years. But looking at just the balance sheet of basically across all the pension funds in Sweden and the Nordic region, they are very robust today.
Do you bring the money home? My experience on the geography of crisis is, when in doubt, pull it home. Do Swedish pension plans, and would you guess European continental plans, do they just bring the assets home?
I think the underlying fundamentals of the U.S. market is still very attractive for any investor. So I think in the mid to long term, U.S. will always be able to attract investors to invest into the market space. That goes also for the pension funds. And I think looking at the size of many of the pension funds in the Nordics and the European space, they need to diversify into the U.S. market and other regions around the globe. So I think I have at least a positive mid to long-term view on the U.S. market's capacity to deliver shareholder value to us.
Magnus, you have a problem this morning, as most people know, so let's talk about that problem now. How does a Swedish pension fund end up allocated to Signature Bank, First Republic, and SVP?
Yeah, I mean, we invested in those companies starting 2017 up until 2019, and we've been growing that allocation over the years. So obviously, we thought that the initial year was good for us investing that, but with what's happened last week, obviously, we think it's a big failure for us as an investor, and we need to learn something from that and take actions based upon the lessons learned. So it's a failure. I just want to sort of put that in proportion to the total portfolio that we're managing. We're talking about 1% of our total capital that we manage. So from a customer point of view, this does not have a material impact at all. It will not impact the pensions that we are committing to our customers.
I understand that, but it does speak to weak internal controls and
yeah.
some odd decisions that we need to talk about, Magnus. The fact that you were allocated to those names, but some of the conservative Swedish lenders, you ended up selling those positions in 2022. So I guess the question that will be repeatedly asked of you is just what happened? What happened, and why did you buy more of those names and sell more conservative names?
Well, those are two separate issues. The divestment of the Swedish banks is a standalone assessment of the decision made at a different time. Talking about the U.S. banks, what we liked about them was the market position, the position when it comes to transformation in the digital space, and the U.S. market, generally speaking, the depth of that and the size of it. We had discussion with Silicon Valley Bank during the fall because we also saw, as many others, the withdrawal of deposits and the investments the company did in the long-term government securities and what that led when it comes to duration and liquidity aspects. We thought that the action plan that the company had was, they were transparent about that, and we thought it was well thought through. Then last week, the company acted not in accordance with the action plan we had discussed and talked with them about and that we had been presented to. And that surprised us, and I think that was a big mistake from the company's side.
Well, clearly, Magnus, it didn't just surprise you, it surprised many people, including the regulator here in the United States. So a lot of people have questions they'll need to answer as well. I want to understand how you've responded to that in the last couple of days. So you've identified some banks that you hold that haven't managed their interest rate risk properly. Are you worried that you also hold some European banking names that maybe are in the same position, perhaps even worse, given what's happened with the bond market there over the last couple of years?
We see in the European market as well withdrawal of deposits, and it's increasing. So we're monitoring that very closely, and we're monitoring basically the whole exposure we have to the banking sector, which is in total 2% of the total portfolio. So I think we need. The last few days has been, escalating a little bit in the European market, but we're not monitoring that. I think the loss to equity ratio is completely different or very different in the European space compared to some of the banks in the US market that you mentioned earlier.
Magnus, can we just focus on Europe just a little bit more? Do you hold Credit Suisse?
No, we don't.
Have you sold any names in the last 24 hours, the last 48 hours? Have you de-risked around European banks at all in any way, shape or form?
We have not. We hold shares in two Nordic banks, SEB and Nordea.
You also, though, have taken on these credit risk transfers over the past few years, or basically you take on the risk associated with particularly European bank books tied to commercial loans, distressed debt. How confident are you that those are going to be solid investments?
I think the banking sector in Europe is stronger than what they were in prior to the global financial crisis. So I think we're in a better starting position. Obviously, a lot of things are happening right now, and it's clearly a transition phase that the market is going through with the enormous increase in the interest rate that we've seen in the past 12 months and the speed of that. And we haven't transitioned through that yet. But I think the banks, the Nordic banks that we hold shares in, are in a solid position as of today.
Given the bet that you made on some of the U.S. banks, I'm wondering how you're handling the fallout, whether you're getting out of the positions, whether you're doubling down, whether you're buying more. What's been sort of the positioning over the past couple of days?
Well, when you talk about the Silicon Valley Bank and the Signature Bank being in a receivership, I think it's more a legal issue for us to ensure that we protect our legal rights there. I don't expect any value to come out of that as of today. When it comes to First Republic, obviously it's very volatile and it's day to day basically. Yesterday it fell a lot, today it's up again. We haven't taken any decision yet, but we are ready to take decisions as we see appropriate for us at any stage. But we haven't taken any major actions today with regard to that bank.
Magnus, every crisis unfolds with a certain character. We make note of Sweden's wonderful work many, many decades ago in inventing a whole bit of central bank theory with how Stockholm handled a crisis. The theme right now seems to be the shadows or the mysteries of private equity and venture capital. In America, conservative money is addicted to the potential return of that group. Are you exposed to private equity and venture capital, long-term locked-in holdings, and do you worry that there could be some real issues there with liquidity?
In our equity portfolio, our investment model is predominantly focused on more mature companies, and we invest directly in those. So we're looking for strong cash flow rather than potential growth and future positive cash flow. With that said, that means that we basically don't have any private equity exposure and VC exposure in our portfolio.
You've been doing this for a few years. Do you assume in crisis, with the way yields are gyrating, the way all central banks have become more restrictive in the last 4 or 5 days, do you suggest that not the actuarial assumption, but just the expected return of pension portfolios will come down?
Yes, I do think that the next 10 years will be more difficult to generate return. And I think we will see changes in the investment models in the pension fund industry in order to secure adequate return for the beneficiaries.
Sir, my great theme here is we've had interest rate come in as we've come back and normalized yield, certainly normalized yield within the European sphere as well. Is it troubled non-profitable companies, what we call in America zombies, that they will go away, whether they're banks or anything else as well? Do you suggest that we will see combinations and transactions to clear out companies that have had essentially a free lunch for 16 years?
Yeah, I do think some companies have benefited too much of the central bank's put and the fact that we've been living in a world for many years where cost of capital has been basically zero. And I don't think that that is sustainable in the long term. And I would suspect that some businesses out there will struggle to adjust to a more normalized interest rate level long term.
Magnus, as you and I are talking, as we're all speaking, the first deputy governor of the Swedish Central Bank is addressing Parliament at the moment, suggesting that we need more tightening despite volatility. There are people who believe that things are breaking now and these central banks need to back away. Can we finish on that? What's your take on that?
So I didn't hear the question properly, so could you...
I can repeat it, sir, by all means. So the first deputy governor of the Riksbank is speaking to Parliament right now, suggesting that we need more tightening despite the volatility. Magnus, as you know, the conversation in the last 24 hours is that some people believe things are breaking and central banks should back away. What's your take on that, sir?
I do think that we in the market space today actually see a de facto tightening, and I think that should be catered into the policy decisions to be made going forward. It's very difficult assessments to make, obviously, but I'm a little bit concerned that we're breaking the markets if we're too aggressive. Obviously, we need to bring down the inflation because that is the long-term number one foe for all the market participants. But it's a balancing act here. And I think, again, that the current de facto market tightening that's happening should be catering to that consideration.
Magnus, it's a difficult time for everyone, particularly for you this morning, and we appreciate the opportunity to speak with you at that difficult time. Thanks for being with us. Magnus Billing there of Electa, a Swedish pension fund with exposure to all the wrong names over the last 3 days, that's for sure. If you are just tuning in, good morning to you. We're going to whip through some price action just to give you a feel of where things stand at the moment. Your equity market on the S&P 500, slightly positive, slightly negative at the close in yesterday's session on the S&P 500 at the moment. We're positive by about 0.5% on the S&P. In the bond market, yields are a little bit higher by 4 basis points on a 10-year, 361.49, a whole lot higher at the front end, after being a whole lot lower over the last 3 days. 3 days, 100 basis points lower, just unbelievable. This morning, your 2-year up 27 basis points. I think 2 names for many of you stand out this morning and over the last couple of days on both sides of the Atlantic. Let's start with the US side of things. First Republic is positive after being slaughtered over the last couple of days. It's up by 22%. And Lisa, Credit Suisse at the moment is down about 4.8%. We're trading at 214 and just off record lows, session lows.
And to be clear, this isn't just the fallout from what we saw in the banking sector. It's also because there's a new headline. They can't catch a break with this, that they found material control lapses after the SEC prompt in some of their reporting in 2022 and 2021, even though they say that it fairly presents its financial condition. But these are not things that you want to read about at a time when there are questions about the integrity of balance sheets on certain banks, and when you've got all of these jitters around who's the strongest.
I read that it was a really short statement here. We've got, John, I want to go over these headlines from Credit Suisse here. Sure. I think they're very important. I'll let you lead on that. But I think what is important here, Lisa, is PricewaterhouseCoopers made that happen. There's no question in my mind that the American audit system stepped up and said, no, we're not going to agree to this. And PwC came in and said, maybe not.
So we've got 2 things, haven't we? One, Lisa mentioned it. It fairly captured, they think, their results. Okay. That's one part of this story. That doesn't mean the story's done. No. Credit Suisse turns around and said they've got problems with their internal controls, TK. That's the last thing you want to be saying at a time where the stock's near a record low. Yeah. And we know there's been management issues there for a long, long time.
My experience is with accounting, it's always ratios, compare and contrast. And I'm not going to pontificate as the numerator of a given ratio bad or the denominator, but my guess is the audit adults are looking at the construction of their ratios and saying maybe it's a little off here, maybe it's a little mysterious there. What's important to me is that PwC stepped in here.
I just wonder who's going to come in and be the white knight here, because this is a story that's been bleeding to record lows when you look at the stock prices, and people are wondering, okay, well, what's the solution here? This isn't necessarily a bail-in, a bailout, call it whatever you want. This is something else, and the potential for Middle East investors to come take over is what everybody keeps floating.
John, I'm going to do this right now. I don't ever do this, but I'll do a fancy technical analysis, and this is off of 3 moving averages, and the answer is Credit Suisse opened, went south 222 down to 215. I'm looking at a 10-minute interval chart for those keeping score at home. And John, there's a middle moving average that this stock can't break through. 1, 2, 3, 4, 5, 6 intervals they've tried to go through, and they can't bid it up.
Right on cue. Just got told some fantastic news. Walking into the building in London, the Credit Suisse boss, the CEO, is going to sit down with Francine Lacqua.
What's your first question?
In about 90 seconds. Well, let's start with the news first, right? Got to start with the news first, and got to start with the fact the stock's at a record low. TK, how much trouble are we really facing here with this name?
And the key question, and it's so foreign for me because I really, we make jokes about it, folks, but let's be honest. We're flying blind here. Signature Bank, I wasn't surprised because I know the heritage of New York State regulation. They're really, really serious. I don't have a clue about Swiss regulators, Switzerland regulators. But John, I mean, in America, you're under 5, you're under 4, everybody sits up and watches. We're going to be under 2 here in a bit.
How do you project confidence when it's been one bad headline after another? This is the really difficult question. How do you basically garner inflows, whether it's wealth management or depositors, at a time where we have already this incredible competition with other banks? And then how much does the pressure from what's going on in the U.S. really add to the difficulties in reshoring a lot of the support that they've had from previous investors?
That conversation coming up very, very shortly. The Credit Suisse CEO sitting down with Francine Lacqua. Looking forward to that conversation. Just waiting for them to get settled, and we'll pass over to that in just a moment. I'm going to go through things for you. Just start with equities, then go to bonds, and finish on foreign exchange. And interesting to hear the Swedish pension fund turn around and say they're seeing deposit outflows in certain places in Europe too. Yeah. That's the problem. And Tom, we talked about the duration issue as well, the duration issue over in Europe. If you think that some US banks have mismanaged their interest rate risk, think about what's happened to duration in Europe over the last 12 months.
This is really important. John is really, really quite good on this. John, we look at America at 7 years, the belly of the curve, the outside of it. 10 years is the benchmark. We go out to 30 years. Pension funds over there, much more conservative. Outside of the crisis, don't they feel comfortable locking in a 25-year piece?
Certainly the story in the gilt market, in the UK, which is why we have such a much longer weighted average maturity in the gilt market too. Equity futures right now on the S&P just about positive by 0.4%. Big turnaround in the bond market relative to what you've seen over the last few days. Your 2-year yield now is higher by 26 basis points after being lower by 100 basis points in just 3 days. We can now head over to London to catch up with Francine Lacqua and the Credit Suisse CEO.
Thank you so much, John. We are delighted to be joined by, of course, Ulrich Körner, the Credit Suisse Chief Executive Officer. Thank you for joining us. It's a difficult day, another difficult day for Credit Suisse. What can you tell us about the outflows in the wake of SVB?
So SVB, as you know, is a very recent thing which happened over the weekend and yesterday. So far, it's pretty calm. We even saw material good inflows yesterday still. Also, you know, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days to look at that.
Calm, are you suggesting that you could also actually get inflows?
So we got inflows yesterday, which is a positive sign, I would say. And, you know, for us, and that is maybe a little bit, if I may say so, Francine, in comparison to SVB, it's a very different situation, you know. We are GSIP, as you know, we are following materially different and higher standards when it comes to capital funding, liquidity, and so on. And that's why we said, you know, we gave, I think in this situation is important, we gave LCR, liquidity capital ratio of like 140-40 at the end of Q4, which is a strong ratio, which has improved as we went through this quarter to like 150 on average, and spot being even higher on that one. So,
but outflows have not reversed, but they've actually lowered. When are they reversing?
Look, they have significantly moderated, as I put it. We gave an update on February 9 in terms of where we are on deposits and net new assets and so on. We will give next update with the first quarter result. But it is also very clear, you know, and we talked about that, what has happened in like fourth quarter, you know, we are fully focused on it, turn it around, but that takes longer than like just 2 months.
But then you have this material weakness today. What happened there? There's concern that actually almost every day there's some kind of bad news, and you have your share price at a record low. Like, that can't be a comfortable position.
No, but we published our annual report today, so you have seen the financial result. I think that's the key message. The financial result is unchanged for 2022 and previous years. We delayed the report, as you have seen, a couple of days to appropriately deal with, you know, questions the SEC had, and we did. And that is part of a longer ongoing dialogue. And we acknowledge that we have a material weakness in the financial reporting control, which we are addressing and remediating forcefully. So.
How are you addressing that? So is that an auditor problem? You had PwC on the case. Is it their fault?
No, it's absolutely not their fault. That is obviously, you know, that goes hand in hand as you work together with your auditor. But it's a collective finding, and we are addressing it. We have a remediation plan, and we are addressing it.
So you have an anchor investor that put 1.5 million in the bank. Now their share value has gone down by 1/3. Will they have to inject more? What kind of conversations are you having with them?
No, look, nobody is pleased about the share price development, you know, but we manage what we can manage. And this is the execution of our plan. That's the right strategy. It's the right plan. We are executing at pace and even ahead of the plan. And I think our shareholders see that as well. That's an unpleasant situation in share price, but I can't manage share price. I can manage the execution, and I do.
So you don't think you're getting pressure from shareholders? You're not getting pressure from, you know, certain big shareholders to do more and actually to have all options on the table?
No, as I said, they're obviously not pleased with the development. And I'm not pleased with the development firsthand, obviously, but, you know, we are executing. And once we are executing step by step, we show the market, and this is exactly why we said it's a 3-year process. And we are executing. And that is, you know, the market will acknowledge that, and the share price will follow.
Do you think all options should be on the table? What about breaking up the bank? If you look, and I understand your frustration with the share price and saying, look, you're just executing. But when you look at the share price, 97% below that 2007 high, like, how do you regain from that?
No, but that you can't compare, as you know. But, you know, As I said, it's a right strategy. I'm fully convinced of the strategy. We are executing at pace. We have the right team. And, you know, that's why we said in October, it needs radical change. You know, the bank needs to be changed. And we said it's a 3-year transformation. And you can't come after two months and say, look, why is not everything done?
But radical change could be splitting up the bank. Is it something that you're evaluating?
No, look, the new Credit Suisse is focused on the core strengths of the bank. This is wealth management, the Swiss bank business, asset management, what we put the market, i.e. the trading and sales business. That makes entirely sense. Entirely different risk profile. Will be very profitable and will reward shareholders. And I think the shareholders understand that.
When will you be able to say, like, the worst is really behind us?
Look, we said it's 3 years transformation. We said we are going to make a loss, unfortunately, this year because, you know, and this is something which you need to understand. A lot of the restructuring costs, you know, baked into the transformation are coming in 2023 before we see a lot of benefits out of that transformation. And that is something which happens. That's why we said it takes 3 years.
3 years is a long time, Ulrich. I mean, a lot of the shareholders will start asking questions. I mean, have you asked them for more money to make it faster?
No,
3 years, especially in this banking world, anything could happen.
No, but you know, as I said, our LCR ratio is strong and very strong. Has getting stronger as we speak. Our capital ratio is very strong at 14.1%. As we gave it to Q4, so we have everything we need to go through the transformation miles.
Are you expecting, you know, the first quarter to be good enough to keep shareholders off your back?
The first quarter is, as we said, and we put it very clearly, we will make a loss in the first quarter, but you will see progress in the first quarter numbers. No question.
In terms of what outflows in certain regions?
In terms of business momentum.
Where specifically?
Example,
business momentum?
In the market business, for example, which was, as we all discussed, for reasons. Clearly understandable reasons, weak in the Q4, looks better. Wealth management, we are making progress. Certainly not there where we should be, but we are making progress.
Are you comfortable with the banking system as a whole? I mean, we've you know, lived through a pretty incredible couple of days, and if you look at the markets, they're all over the place.
No, I think so. I mean, it's a somewhat an isolated problem if you want to. And as I said, you know, if you are G-SIBIT or if you look at large banks, I think we will manage through it.
Talk to me a little bit about Credit Suisse First Boston. So first of all, what's the timeline for the IPO?
The timeline for Francine is unchanged, as we discussed last time. So we have a very clear plan to put it into market, create a liquidity event, most likely an IPO. We are working against our internal plans forcefully, and I would expect such an event in like 2025, as I said earlier.
Okay, any news? I mean, today you had news about the 20% that would go to Credit Suisse First Boston partners. What happens to the rest?
The rest is owned by us and obviously also portioned by Michael, as we announced it in like February. And the rest is owned by us. So this is our part of the bank, remains our part of the bank. We are going into liquidity and again, most likely IPO. We will be probably majority shareholder, and then we make decision, you know, how our holding develops over the next following years.
So you're still looking for an anchor investor?
Yeah,
for Credit Suisse First Boston, are you closer to finding one?
I don't know. Yeah, we are close to, but I'm not sure if it's anchor investor. We have a lot of interest from third parties to be invested into that, which tells you something about the strategy, I would say.
Yeah.
And we are evaluating that.
Middle Eastern investors?
Different kind of investors, different parts of the world.
But large chunk investors?
Made that decision, and I will inform you first. As you.
Oh, okay, how far away are we from that?
We are pretty close, I would say.
A couple of weeks? Will it come before the first quarter?
I will tell the market if we are there.
What do you find most difficult about your job?
Is to make it understandable, I would say, you know, that we are absolutely doing the right things, that we need some time to get through. And this is what all my colleagues and I try to do, you know, to regain the trust of the bank over the next couple of months.
But is it more important to regain the trust of shareholders or clients?
It is, look, clients is, I told you last time, clients is, I would say, one of the best experience, even in this very difficult months last year. I mean, they are so supportive of us. They are listening to us. They are doing active things to support. They like to bank with Credit Suisse. It's a fantastic experience. But, you know, the convincing of this is the right thing to do. We are executing at pace, and the head of plan is with all different stakeholders, all different ones.
But why are they taking money out then? If your clients are happy?
Because, and that's what I also said, if you are in a situation like we were in October, where you had malicious information out in the market at the beginning of October. We were not able to speak, legally not able to speak. And that's why I said, like 2/3 of the outflows stemming from October alone, 85% from October and November. And the moment we could reach out, we started that huge program, talked to our clients, more than 10,000 clients in wealth management since then, more than 50,000 individual meetings in Switzerland, and that has created momentum.
Are you frustrated, though, that actually you haven't been able to get ahead of that quicker?
No, I think we are really doing the utmost possible, and I'm proud, not frustrated, I'm proud of what my colleagues, my people at the front units have done since months. I'm really proud of.
But the message today, I mean, if you look at your share price, you're proud, you think you're executing, you're on a 3-year plan. If you look at the share price at a record low, does your stomach sink a little bit when you look at the share price?
Nothing which I like, obviously. But look, I can control what I can control. I don't control the share price. I control the execution of the right strategy.
And you think the share price will catch up if you execute? All right, thank you so much for your time. That was Ulrich Körner there, the Credit Suisse Chief Executive Officer. And with that, I'm going to send it back to you.
Hey, Francine, just absolutely fantastic. What a timely conversation speaking to the Credit Suisse CEO out of London this morning. Credit Suisse down by 4.9% still. The stock at about 215. The headline we got from the Credit Suisse CEO, I have to say, surprised by this line. Tom, surprised to hear it. The Credit Suisse CEO saying the firm saw client inflows on Monday.
Okay, it's one day. I'll go with that, and I guess it's a triumph as well. I think a lot of people, and I'm really looking at what's called the 10-minute interval stock, and this is not what we do in surveillance, but the fact is this is the mood of a crisis financial world right now. The fact is during Francine's wonderful interview, he didn't generate a bid. On the Bloomberg screen, there was no bid during that conversation.
I think Francine did a wonderful job asking all the right questions. He's in a tough spot, though, to answer them right now, Tom. That line that we'll see progress in Q1 numbers, you get Q1 results on the 27th of April. 27th of April feels like a long, long way away.
You think?
No, I feel like a week right now in this world. I said this yesterday. In a world where a bank can fail in like 24 hours, as we saw with Signature Bank, as we saw with Silicon Valley Bank, a month's a long time.
27th of April, first of all, that's when the Red Sox are out of the pennant race. But other than that, it's way too far out. And in his defense, these guys are hardwired to look out strategically, except he did not answer the present tensions in crisis, other than to say, I believe he said they're close to large pools of money coming in. Francine and I went back and forth on that before her great conversation. The fact is he should have identified the immediacy, and as I see here at 2.145, and we're not going to make this a technical show, John, but the answer is he didn't find a bid on the chart.
So, Tom, language is important, and one of the many reasons I'm honored hosting the show every morning with you guys is the audience out there, particularly the terminal user, one of the sharpest, smartest audiences, I think, on the planet. This note right here across the Bloomberg, he didn't say net inflows.
Yeah.
He said client inflows, he didn't say net inflows, and I think that's probably an important distinction, Lisa.
He also said, when Francine asked how much are they seeing some sort of positive growth in the first quarter, he said, we're seeing progress. Yeah. She said, what kind of progress? And he said, business momentum. And she said, client inflows. He said, business momentum. So this is going to be a question
business
ongoing.
You tell me, TK. No idea.
Hold a party at Brasserie Lipp in Zurich. Okay, Francine Abramowitz. Lisa, you're better at this than I am. Can you tell us?
New name.
Yeah, it's
she and I, we're going to get out of this. Family. Carry on.
Folks, it's been 6 days of no sleep. Let's use that as the excuse. Lisa, you know the symbols for this. What does their debt structure look like now, including their credit default swaps?
Well, if you look at their perpetual bonds, their credit default swaps are pricing in a near record level of distress. But if you take a look at their perpetual bonds, they were traded actively yesterday and sinking to some of the lowest levels we've seen. Look, right now, you are seeing the market raise signals of concern about this bank. Question is, given how far it's fallen, what can it do to resurrect it? Was that discussion enough? The market's saying no.
Yeah, it's rolled over again. Yeah. Stock's down 5%, Tom. 214 on Credit Suisse.
Well, and again, maybe we'll get the screen up here at some point, folks, because we just don't want to do a fancy thing here. But the answer is we will continue to monitor Credit Suisse. I've got just as initial resistance, folks, for those keeping score, 2.15, 2.16. That's two. What are they? Are they Sun teams? pennies? What do you call 100th of a Swiss
keep
franc?
going.
A Frankie? I don't know.
We can call it Frankie if you want. The Swiss are going to love you this morning.
We're going to migrate right now off of Credit Suisse and go to another bank that starts with C, doing much better this morning, and that would be Citigroup. He is Chief U.S. Economist at Citigroup, Andrew Hollenhorst. Andrew, you have led the way on some form of vector to get to higher interest rates. This is where we're going. Did they go too far, too fast?
I think we don't know, Tom. I think we're going to find out that it's not the case that they've gone too far or that they've gone too fast. But the Fed is managing three different things. They want to achieve price stability, they want to achieve financial stability, and they want to achieve full employment. We've been in a situation where the only one issue was price stability, inflation that was too high. Now they have to balance between financial stability and price stability.
I went back pre-Volcker, Andrew, and the first derivative rather of what they accomplished, going from next to zero. John knows the numbers better than me, up to the new rate. It's never been such a steep movement. Did they cause this fight? Did Jerome, to keep it simple and sensational, and with great respect to the chairman, did his trajectory with his Fed compatriots, did that cause this financial upset we're living now?
Well, causation is a difficult question because we know that higher interest rates had to do with what's going on in the banking system now. Now, did the Fed cause higher interest rates? I would argue that inflation caused higher interest rates. You were going to get higher interest rates because inflation was higher. Now we have the Fed moving against inflation, which is the appropriate thing for the Fed to do. As that process happens, think about what the Fed is trying to achieve. They are trying to tighten credit conditions. They are trying to slow the economy. You'd like that to happen gradually. Yeah. You'd like that to happen smoothly. But does it in practice? Usually not. So certainly not the objective for a bank to fail. And I don't know that we can say that that was caused by the Federal Reserve. The Federal Reserve is moving to slow inflation. That is going to have collateral damage along the way. And I think we've been talking about that for at least a year now, that the Fed should be honest about the fact that when you raise interest rates, you're slowing the economy, you're constraining credit, it is painful. And that's what we're seeing now.
Andrew, you still think that we're heading to 5.5 to 5.75% of an interest rate, a terminal interest rate. I'm curious how lonely that feels, how difficult that's becoming to defend at a time where people are saying, basically, the Fed's done.
Yeah, it's really interesting, Lisa. So we've been on the phone talking to clients about this for what feels like an eternity, which has really been just the last couple of days. And I think consensus is really, there is no consensus here. There are those that think that this could materialize into a bigger financial sector problem. If that's the case, if we continue to experience the kind of volatility that we experienced yesterday, would the Fed be hiking throughout that? Probably not. Would we get to those higher rates? Probably not. Would we have a risk to economic growth that would bring inflation down? Potentially. So I think that there is that scenario. But when I look at what's going on, I do not see that as the likely scenario. I think what we have going on now is still relatively constrained to one part of the economy. We have deposits that are moving around the banking system that are not net flowing out of the banking system, at least as we can see so far, and that's something that everybody's going to be monitoring. So that risk is there, that there's going to be a financial stability issue that prevents the Fed from hiking further. But I think the early read on this is that that's probably not going to prevent the Fed from hiking further. And then you move back to that price stability issue. If the Fed does not hike next week, there will be real questions about whether the Fed is also committed to price stability. It's very difficult for the Fed because they have to both balance the financial stability and the price stability. Not hiking next week would send a signal that perhaps the Fed is not that committed to the price stability mandate.
Andrew Hollenhorst, Citi. Andrew, rock in a hard place, and I'm with you. There is zero consensus right now. Andrew, thank you very much for joining us. We've all gone through the calls in the last 24 hours, the calls for a pause from the likes of Dan Iverson at PIMCO suggesting that maybe that's the direction of travel here. Goldman Sachs, Wells Fargo, Barclays, others looking for a pause. The more are looking for more. They're looking for a rate cut, and they're looking for the end of QT as well. There are those, though, Citi, Tom, I think Bank of America, Mike Gape, and I'll catch up with Mike a little bit later, still looking for a move next week.
Yes.
And next week, to the point that we've all discussed so far this morning, a week is such a long time in this market. at the moment.
Well,
Who knows what CPI looks like at 8:30
Exactly. I'm
Eastern
going to get
time.
to 90 minutes here, and then we'll see if Michael Gapin has to adjust or not. We are all data dependent, but around that is to maintain Greenspan's measured. The person who's had the best 4 days here is Alan Greenspan. He used to pound the table, be measured, and the debate there with Andrew clearly stood his ground that he wanted rates higher faster. Greenspan would have said, measure it out. Take your time. Observe the data nationally is where he would have been.
We will observe the data at 8:30, CPI just around the corner. It's inflation this morning, and we've barely discussed it, which tells you about this market we're in right now. Futures right now on the S&P positive 0.4% from New York. This is Bloomberg.
Is important to you to have women in business? Are you trying to be a role model? And have you tried to be a role model for women in the business world?
Well, I think it's really important to have diverse voices at the table. And in business particularly, because, you know, most consumers are women also.
Just to add to my anxiety levels, which are already through the roof, I want to talk about the social consequences of this, because it seems like an environment where inflation is high, growth is slowing, you know, the Fed is explicitly trying to boost unemployment. Like, it seems like that is probably the worst environment for, you know, your average person on the street. And it almost seems like the Fed's goals here, they're almost anti-American at this point, or like anti the American dream, right? Like housing more expensive,
crushing the housing market,
crushing demand, crushing labor force. Like, what are going to be the social consequences of central banks, you know, having to do this in order to put a cap on price increases?
They're going to be severe. You know, we're already seeing, of course, a backlash against free market, backlash against trade and globalization, even a backlash against technology, a backlash against, you know, laissez-faire policies, because there is even a massive increase in income and wealth inequality. This is leading to populism of the extreme right and or of extreme left in many countries across the world, and authoritarian regimes becoming more popular across the board. It's a repeat of the 30s, literally.
News breaks. No one covers the world like Bloomberg.
This is the biggest issue right now facing Ukraine. Last year was all about weapons. This year to ammunition, as they are facing a potential this spring fresh offensive from Russia.
They are very hopeful that there is going to be a recovery. It's not as bullish as some people were hoping. Obviously, markets today very disappointed with the numbers.
This next president is really going to have to come in quite aggressively to deal with a lot of these economic issues that people are dealing with on a daily basis.
Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There's certainly a lot of uncertainty, a lot of fear. It's showing up in the bank stocks.
Yes, you are going to see a lot of gyrations in the market because investors are nervous.
It's another source of volatility in a highly volatile market. This is not a great backdrop to invest.
You're not seeing a meltdown in the equity market. You're not really seeing broader risks of a contagion in all markets.
I don't think this is going to lead to a recession. I'm still in the soft landing camp.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is CPI Tuesday, and hardly anybody is talking about CPI Tuesday. From New York City this morning, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Your equity market is slightly positive by 0.5% on the S&P 500. Tom King data 90 minutes away.
Data 90 minutes away. We're really trying to look towards it. Let me do a little bit of a vamp on it now. Nothing's changed in terms of the split between goods, disinflation, outright deflation anticipated by some, but service sector, service sector, service sector. And what to me is fascinating, John, nobody's talking about this. All of a sudden, we're going to get down to $2 a gallon gas for the summer, or Lisa's getting the Hummer out. I mean, there's no, I mean, got 79.08 on Brent. Could we get a 60 handle on West Texas Intermediate? That helps inflation.
And not being talked about this morning because we're talking about the financial services sector. Two names stand out, of course. Credit Suisse is just recovering a little bit. It's down about 3.7%. 217, still dramatically low for that name. First Republic battered yesterday, Tom. It's up about 18% this morning. How those small regional banks do in this country today, important given they got absolutely hammered in yesterday's session.
I'm sure Secretary Yellen has a team looking at this, and the answer is they've had a good couple of hours of relative calmness after what we saw yesterday. It still comes down to flows, and when Francine Lacroix was speaking with the head of Credit Suisse, he didn't want to talk about flows. Lisa was great on that. Flows, net flows, net flows. It's like our start. I can't make it up.
Client flows got better seems to be the view they're trying to push this morning.
Flows at the American banks as well.
I hear you. I hear you. Got to talk about the Federal Reserve as well. You've seen all the calls, you've heard them. Here they are so far. Lisa, PIMCO, Dan Iverson, always fantastic to hear from him, suggesting we might get that pause. Goldman, Wells Fargo, Barclays, all joining the pause brigade. Nomura going one step further. Rate cut. We spoke to Andrew Hollenhorst, the City, 10 minutes ago on this program, and Andrew basically said there is no consensus. I think Andrew acknowledging, yes, he still thinks they're going to hike, but ultimately, who knows where we are in a week's time.
The tension right now between inflation that is not dead, that is very much present at some of the highest levels we've seen in 4 decades, and this concern about financial stability that we still haven't seen fully shake out, right? I mean, have we seen the end of it? Does the bounce today and some of these shares really indicate that we have passed the corner on this? To me, that's unresolved. How does the market handle a hot CPI print today? What kind of whipsaw action do you get when suddenly people priced out the Fed yesterday and have to reprice in 5.5% Fed funds rates today? You could see some real gyrations at a time where the implied volatility right now in the bond market is the highest going back to 2009.
What's the index look like? I haven't looked. Is
it's
it like
an absolute surge to the highest level since 2009.
Didn't just price out hikes, priced in loads of cuts. Just the reassessment yesterday was just phenomenal. 60 basis point move at the front end of the curve. Yeah. Come on, 100 basis points in 3 days. From north of 5 to south of 4.
I did the thing for Twitter and YouTube yesterday, and I said, where is Jerome Powell? And if I was a president, I would be having Secretary Yellen and Chairman Powell speak.
To say what? But to say what? I mean, honestly, what are they going to do? Come out? We have no clue either.
Institutions in crisis should speak. When surveillance is in crisis, John Farrow speaks.
Tries to.
Tries to.
Can I just say this? What a timely arrival of Lael Brainerd to the National Economic Council, Tom. What a timely arrival for her to be there with the administration at a time like this.
Yeah, well, she's any place she arrives. I like her to manage the Red Sox, but the answer is yes. It's hugely timely and will be of great assistance. My question into this morning to all of America, particularly people that aren't fancy on this, is I lost my train of thought. 3, 2, 1. You've got to listen to the public, and they're scared stiff. That hasn't gone away.
I lose my train of thought every time Lisa starts laughing at me too. Why are you laughing?
Because you said Lael Brainerd. Yeah. It's very timely.
It's very timely.
Yeah. Okay. So you're basically saying that she helped to orchestrate this to basically offset what she sees happening. Yeah.
No, I would never say that.
I would have thought she had a massive
John
role.
and I would never.
Isn't it safe to assume, as the chief economic advisor to the president, she has a big role to play over the weekend?
So I wonder what her assessment, having worked at the Fed, would be. I'm just saying timely. Okay.
It wasn't a loaded timely.
No,
just
a little
timely.
Here's let me go through the historic path on this, including a final lunch I had with the wonderful Anna Schwartz just before she fell. She was in her 90s. Friedman Schwartz, and then Alan Meltzer and Milton Friedman and in that range. And then a guy named Ben Bernanke is the one that codified that the strength of the financial system is what keeps a Fed going in crisis. That's where we are now. And Brainerd, to your point, John, studied this linkage in history of finance. I think the Chris Whalen's one volume on this is brilliant.
Yeah.
The financial system linked into central bank babble. The media, all three of us are guilty of this. We do the parlor game. It doesn't matter right now. It just doesn't matter.
You mentioned policymakers speaking more, Tom. I think the last thing you want to do when you're setting policy is chase your tail and keep announcing new things. The question we asked yesterday morning, the announcements of Sunday evening, are they sufficient? Let's see it play through the market. Quite clearly on Monday, there was still this nervousness. Let's give it another day, give it another day. And the hope is that it is sufficient, they have done enough. I think the more you come out at a time like this and talk even more and come up with something new, you're just basically saying everything we announced on Sunday didn't work, not enough.
I think silence is the perfect response right now from these officials.
For now, we'll see, Lisa.
But honestly, yeah, you're right. But I think that right now, the fact that the quiet period is right now is actually highly convenient for Fed officials, because what do you say at a time of just great uncertainty when everyone's just throwing up their hands and saying, we don't know?
He could come out with a vetted and prepared statement that I'm sure Vice Chairman Brainerd helped him with. I mean, there's no question. He doesn't have to ad-lib this. He can come out with a prepared statement. But, and frankly, he does it, am I right, John? We can state, even with Credit Suisse with a bid for the last 20 minutes, we can state it's a little more constructive than it was at 3:55 yesterday afternoon.
Well, let's go through it, and then Lisa can go through the day ahead for you. So your equity market elevated by 0.5% on the S&P 500. That's a bounce. A minor loss yesterday of 0.1%, but the sector split was pretty obvious, wasn't it? Financials. No. Hammered. If you look at the bond market, yields are just a little bit higher by 2 or 3 basis points on a 10-year, much higher on a 2-year. On a 2-year yield this morning, we're higher by something like 20 basis points plus after drifting aggressively lower over the previous 3 days. In the FX market, euro dollar 107.16, we're negative 0.1%. We're all fed up this morning with the Federal Reserve. What about the ECB, Bramo? The ECB's got to make a call on Thursday after essentially, and they will hate me using this language. Their language,
are we going to Frankfurt?
They were suggesting pretty strongly we'll get 50. I think a lot of people in the market took that as a pre-commitment to 50. And now here we are, Lisa, going into Thursday.
Yeah, we're going to get there in 1 second. But I do think right now the ECB is in a much worse position than the Fed, because at least the Fed has a couple extra days. And honestly, at this point, a couple extra days, as you've been saying all morning, is like a couple years in this market. 8:30 a.m., we get the February U.S. CPI print. What does this market do with hot inflation? That, to me, is a complete mystery wrapped in the mysteries of the moment. We are expecting core inflation to come down to 5.5% from 5.6% on a year-over-year basis. But what happens if it stays hot at a time when the Fed is still fighting inflation at the fastest pace going back 4 decades? Today, EU finance ministers are gathering in Brussels. And to your point, John, the reason why I find it really interesting what they have to say is because this is just 2 days before the ECB's rate decision. And you have seen a complete repricing, not only in the U.S. market, but also in the European markets as far as how fast the ECB will raise rates or not. We're now pricing in a much lower terminal ECB rate, and that German 2-year fell dramatically yesterday, now only at 2.8% from fully north of 3%, close to 3.4% not so long ago. Today, we also are looking out to the 5:30 p.m. discussion from Fed Governor Michelle Bowman. Probably not going to be talking about Fed policy since it is the quiet period. She's going to be talking about innovation in the banking system. That will also be interesting right now, considering the innovation in the banking system, John, is also potentially in the forefront.
Oh, she's really not.
Has that speech been rewritten? I can't believe that speech is even still on the schedule, Tom.
She's very, very good, but you cancel
it. Doesn't matter how phenomenal you are. You would have been in Hawaii talking about the banking system, but not addressing what's taken place the last week, or giving some suggestion what it means for Fed policy.
I don't think we're giving away family secrets here, but many of our guests over the last number of days, they want to come on for the smart conversation, and all of a sudden, well, he won't be able to attend. There's a little bit of that going on.
Well, I'm happy to say that this morning, Phil Camporelli at JP Morgan.
Here. Oh, he's
Phil, do you know what Phil did? He just ran through the rain and said, I need to be on Bloomberg surveillance. I need to be here. Hey, Phil, it's good to see you.
Good morning.
Thanks for rushing in.
All right.
What do you make of this reassessment of the Fed this morning, off the back of the move we've seen in the last 3 days?
Yeah, so I thought March Madness was a basketball thing. It's not. It's a capital markets thing. I mean, this is crazy. So one of the things that we'd say is, bonds are a really nice place to be. except for last year. And now what we're seeing is you now have a market where bonds are negatively correlated to equities. Now, that's the first thing. The second thing is, if the meeting were today, the Fed would be absolutely tone deaf to move rates higher. I don't think we should be questioning whether the tightening cycle is over yet. I think that's premature. But at least for the very near term, it would be hard to believe that a move higher in rates would be warranted right now.
Without giving away the secrets, what are you seeing in the last 3 or 4 days as you've had a phone glued to your ear? How are clients reacting? Are they allocating to a new belief, a new position? Are they staying pat? Or are they just simply scared stiff?
Well, you know what the thing is? We were looking at the entire yield curve last week, and the 6-month T-bill was the highest yielding part of the
Is that what triggered this? Was a 5% money market fund? A lot of people are saying, we hit 5.00, and everybody said, oh, that looks good.
That looks pretty good, right? Well, and I'd also say that I think the chairman last week had almost an October of 2018 moment. In October of 18, he said, we're far away from, he ate his Wheaties that morning, we're far away from our neutral rate, and that caused some havoc in the fourth quarter of 18. I'm just not sure why last week in the testimony he was that over the top aggressive, and I think that might have triggered some stuff. So what clients are thinking right now is, okay, there's negative correlation with bonds again. And I think that's what people are asking the most. What's the sweet spot part of the curve for us to be able to get protection if other parts of our assets are moving lower? And for us, I think that's the 5-year part of the curve. The 5-year part of the curve offers us the combination of yield plus duration.
And this has been a call for a while. I'm wondering how you've reset your understanding of markets on the heels of the volatility that we've seen, on the prospect of possibly fewer rate hikes due to financial instability at a time where inflation is still a problem.
Yeah, so I think financial stability is the #1 priority. So the way that we're resetting, right? It's not full employment, it's not price stability, it's financial stability for policymakers. And I think if financial stability were to unravel, Lisa, inflation would kind of take care of itself. But at the same time, it's too premature to think that. It's only been a couple of days. The way that we're resetting is, A, we're not overweight equity. Okay, that's first. Second, we had an overweight to duration, so we were more interest rate sensitive than our benchmark when the 10-year notes hit 4%. That seems like a long time ago, but now, you know, we've moved about 50, 60 basis points lower. That's what we've done. We're underweight the U.S. We're underweight the U.S. dollar versus currencies like the euro and the yen. I think that makes some sense in this environment because, again, if you remove all of those rate hikes and you have an environment where the European Central Bank, if this is a U.S. issue, continues to move, that creates a really good environment for the euro versus the dollar. And repatriation into places like the yen at the end of their calendar year makes some sense. So you put that all together, and it's a pretty defensive portfolio, but not in a way where we're terribly underweight equity, Lisa. I just want to make that clear. We have a preference for non-U.S. equity over the U.S., but we're pretty much neutral our benchmark on equity. And I think the duration and dollar story really go hand in hand.
Everything this morning over the last week looks very challenged over the last few days. Phil Camper was able to sit there for 2 days and have no idea that a bank in America was, it's amazing.
You have to measure the trust and the confidence. French Hill, I believe, is scheduled to join us. He actually ran a bank at one point.
That conversation coming up.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The top names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
So far, it's pretty calm. We even saw material good inflows yesterday still. Also, I had a client meeting which was very positive on that one. So far it's calm, but I think it's early days.
It's early days. That was the Credit Suisse CEO. The stock is down by 3.4%, just off session lows, 218, lower the session, record low, 212 on Credit Suisse stock. They are seeing material good inflows yesterday. Then we'll have to get some more detail on that in the coming weeks. The next earnings report comes from Credit Suisse in about a month from now. They say that we should see some progress in Q1. We'll get that Q1 report on April 27th. And as we've said repeatedly, April feels like a very, very long way away in a market moving as quickly as it's moving. Tom, I know you're focused on First Republic as well. That stock is up nicely.
Just as one indicator, yeah.
It's another lift. Near session high is up 32% TK.
Nice 31 up to 38-ish, maybe 37, I should say, and then a nice spike up here as we open up for a Tuesday morning. 41 is the last on FRC. Because of time, we're just going to run right to it. David George is senior research analyst at Baird. Very importantly, with decades of experience. David, what are you writing this morning? Let me just cut to the chase. What matters right now for David George?
We wrote this morning, Tom, good morning, thanks for having me. We believe that this is an asymmetrically positive risk reward for regional bank stocks. In fact, probably the most constructive that we've been since COVID. Maybe even more constructive than that. This is one of the best setups that we have seen in the last I've done this 23 years, and this is an unbelievably good risk-reward setup for the stock.
What is the skill set to determine that a given bank is not seeing outflows and that given bank has trust and confidence?
Well, part of it is obviously it's difficult to predict customer behavior, but I think something that has gone undiscussed in the financial media is, and I don't cover Silicon Valley, but I think it's important to note that they have $220 billion in deposits. Do you know how many branches they had? 18. Do you know how many branches U.S. Bank has? 5,000. The average deposits per branch at most U.S. banks is about 15 to 50 million, not 2 billion per office. So the granularity of most U.S. regional banks' funding is just infinitely different than the kind of banks that have been reported that have failed. So obviously we are in a period where investors have long memories and there's panic, but that is where you get these asymmetric opportunities, and that's where we are, in my opinion.
That said, David, there's a very different scenario that is uniform pretty much across all the banking sector as well as beyond, which is the immediacy of being able to withdraw in real time, online, at any time, the ability for there to be a bank run that happens so quickly that even regulators are caught completely off guard. How does that change your risk assessment of smaller banks, especially at a time where cash is paying something and a lot of people are concerned that these banks are not going to be able to deliver?
Well, first of all, I am not concerned. Maybe that doesn't matter. But to your second point, Lisa, the movement of funds into treasuries and higher yielding alternatives, that's been going on for over a year. So that is not a new phenomenon. Now, how people feel about that, given where the stocks have been trading, is new. But fundamentally, that has been happening for several months and several quarters. In terms of the movement of deposits and things like social media and media like yourselves talking about bank runs, that's really not that helpful, to be honest, to depositors, because most customers of regional banks do not have millions of dollars. They've got maybe $5,000 in a checking account. Maybe a small business has got $100,000. They are not focused on this. They are focused on running their businesses. So I just think that the similarities between Silicon Valley and most other what I would call Main Street banks couldn't be more different.
That said, there is this concern about the interest rate risk at a lot of banks, and I am wondering from your perspective, putting aside, what the media's role is, or what investors' role is, or what the reputational risk is, what about the nuts and bolts, potential unrealized losses on the balance sheets of a number of regional banks that haven't necessarily hedged against a dramatic rise in interest rates and among all of their assets they use to back those customer deposits?
Well, a couple things. So banks, as part of the Dodd-Frank legislation, have to own securities as part of what's called the LCR, liquidity coverage ratios. And keep in mind, Silicon Valley and banks under $250 billion in assets are no longer subject to that legislation. All of the big banks that we talk about are all subject to that, by the way. That's another thing that has gone unreported and unnoticed and undiscussed. In terms of the interest rate risk, yes, there are banks that are sitting on securities. These are money good securities, by the way. These are treasuries and MBS that pay as agreed. These are not subprime loans. These are not CDOs. These are money good securities. And by the way, deposits have value as well. They are not marked to market either. So despite that, you have banks that are generating, JP Morgan, what did they make last quarter? $8 billion of earnings. B of A made $5 billion of earnings. This is just not a crisis. 2008 was a crisis. This is a very short-term crisis of confidence driven by one bank that was essentially a levered PE fund. So from my perspective, there are obviously unrealized losses. And by the way, with bonds rallying, those losses are now becoming gains, and that will change over time. But most banks will hold these securities until maturity. But I think just to say that these banks aren't managing interest rate risk, I think is not an intellectually honest statement from my perspective.
Well, David, it's always fantastic to get your perspective. Repeatedly through this conversation, you do sound somewhat frustrated with the way this story has been covered over the last 3 days. What would you like to hear more of going forward? What are the questions that you think have been missing?
I just think that the constant focus on is your money safe, it's just, and I think the proliferation of social media is obviously something that I know you're not necessarily engaged in, but I think it's just important to, I think it's important to just distinguish between banks and their funding and their customer bases. And this particular situation is frustrating when you've got not to get political, but when you've got a VC legend tells everyone that screams fire in a crowded theater. That's not helpful either, and that's a whole nother discussion. But I think the main thing is just having some differentiation between banks. And by the way, there will be beneficiaries of this. All of the large banks, as you kind of referenced a little bit earlier before we started the show, they will benefit from this. So there will be your big 10 to 15 banks will be net beneficiaries, which is something that, again, I think has not been discussed. And those stocks have gotten smoked as well.
It's something we talked about a lot over the last 3 days. A lot of money is going to go to the SIBs. There's going to be a premium attached to them just in terms of safety, perceived safety. David, this was great. Let's try and make this regular because I have no doubt there's going to be a story for the next couple of weeks, maybe even next couple of months. David George there of Baird. TK, your thoughts?
Yeah, well, David George was at A.G. Edwards, which is a huge part of the fabric of the Midwest out of St. Louis years ago. I've got a nodding acquaintance with the venerable firm. And the answer is he's somebody knee-deep in will they roll up, will they consolidate, will they out of this crisis, will the strong find the weaker? I'd like to say that David George moved FRC 3 points, but unfortunately I don't think it was Mr. George, folks. It was probably Mr. Schwartzman who did that.
What'd you make of that Blackstone headline, Tom? Iron SVB assets.
This is the way it is. And David, before we saw that headline, alluded to it. There was crisis. I do have an opinion, but I'm not going to give it, on Silicon Valley Bank and what they were doing, the behavior, et cetera. We all can have our opinion on that. The fact is it's Tuesday, it's not Friday, and on Tuesday you begin to do a workout of a blown up bank. That's what we see when we see a Blackstone headline saying SVB assets as I didn't write this, as sort of circle bank. They're circling.
I think David made a good
That's
point. Though.
Westerns,
Over the weekend, there
John
was some.
Wayne
Thanks for that.
movies. Thank you.
Some really
Westerns.
irresponsible comments.
Gary Cooper.
Over the weekend. We're going to keep having two different conversations.
Yes.
I'm listening.
Sounds normal.
Thanks, Lisa.
Anytime. You're talking about some of the venture capitalists who came out and raised some issues
just, you know,
and kind of pushed on
I
it.
actually think those are the kind of voices that make it difficult for the policymaker to actually come and do the things they're saying you should do, because it sounds like you're doing them for them.
Which is the reason why Gary Gensler saying he's going to investigate some of this for potential securities issues is going to be interesting if they can get some more kind of reconstruction of what happened.
Equities right now up 0.8
Credit Suisse
of
up
1%. There we go. That's a turnaround in the last 10 minutes or so.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Equities on the S&P firmer, close to session highs actually, up by 0.75% on the S&P. On the Nasdaq 100, up 0.7%. On a Russell, heavily weighted to the financials, the banks. The Russell 2000 up by about 1%. One name Lisa will talk about in a moment, but First Republic followed a lot at the moment, of course, for obvious reasons. The stock's up big time in the pre-market. We'll pick up on that in a moment. In the bond market, two-year yields down big time in the last 3 days. A 100 basis point move on a 2-year in 3 sessions. Literally, we have not seen moves like this since the 80s. I don't think we've ever seen a reassessment of Fed policy in a single day like we did just yesterday to price out all those rate hikes, basically start pricing in a pause and price in a bunch of cuts. So I think we had a peak rate priced in at the Federal Reserve last week of something like 560. And now what's the peak right now, Lisa? 490?
Yeah, I mean,
Something
it's 480.
like that?
Yeah, I mean, it's just been
480.
going down. It's just shocking, the repricing.
It's unbelievable. Your 10-year right now is higher by 2 basis points, 359. Your 2-year up 24, 422. And just to finish on foreign exchange, I keep forgetting this. I keep reminding myself. The ECB has got a meeting on Thursday. I honestly don't know what they're going to do. They essentially, through all their communication since the last meeting, pre-committed to 50. They were just strongly leaning in that direction. Everything's gone quiet. Things have got messy. Do they back away, Tom? Do they back away?
It is a different cultural force than the Fed, and I think here, with the inflation rates that we've reported and discussed in Europe, I'm going to say this. It's different, and it'll be fascinating to see how the core of Europe adapts and adjusts to crisis, but also to the sustained level of inflation. It's not the same as the United States.
Because yesterday, Tom, we didn't just reprice the Federal Reserve, Lisa, we also repriced the ECB in a major way as well.
And I don't understand how they respond to this, because is this somehow disinflationary for them too if there's a financial system crisis? Well, yeah, if it's a financial system crisis, but is there? And that really brings us to what we want to take a look at today. You mentioned First Republic Bank. Let's take a look at those shares. Yesterday, they were down more than 60%. Today, they are up by more than 50%. How much is this due to some of the sales that we've seen of the assets that we've seen announced, whether it's Apollo or Blackstone? How much is it because people are reassessing the backstop and realizing perhaps they got oversold? But to see that kind of pop shows you where we are. Comerica shares, which were also down heavily yesterday, up more than 14%. Western Alliance shares up more than 35%. If you look at PacWest, those shares up almost 39%. I mean, the bounce back has been tremendous at a time, John, where we're looking at potential stability. So now what does that mean for Fed policy?
We've constantly got to remember where we've been also.
Correct.
We opened last week, I think, at 123 on First Republic. Right now, just north of 46.
Right. So how much is this bottom feeders? How much is this people saying that, you know, these are really cheap, and you see that coming out from a whole host of investors trying to say that? I don't know. I don't know what the signal and the noise is here, whether this is stability or just more ongoing volatility as people try to parse through where we are.
Where is the Fed next week? We'll get a clue on that in about 60 minutes. And I'll go back to what I said yesterday. We said repeatedly, the next Fed position, the next Fed move is at the mercy of payrolls and CPI. We got 311, was it, on payrolls? Yeah. And we'll get CPI, Tom, in 57 minutes.
Now, certainly a constructive day today, and FRC is the best news out there for Jerome Powell right now. This is a joy, and what we want to do, and really this is with the leadership of Bloomberg Technology. Please see what Caroline and Ed are doing there, is we want to talk to people that actually do innovation, actually do technology. Jay Das is Brown Engineering out of Booth School, Chicago. He's a guy that's put all sorts of transactions together for his Sapphire Ventures. We're thrilled he could join us in his early morning. Jay, I want to cut to the chase right now. In 2017, you unloaded on Mark Benioff MuleSoft. Could you do that today? Can you get transactions done after this crisis?
Thanks for having me. Sapphire is a growth stage firm that invests in companies that we think are building companies of consequence. Yeah, to answer your question, I don't think we can unload any company like MuleSoft to Salesforce or to any company, although we do have a transaction going on to a large corporation in the moment, and that hasn't stopped, right? So I don't think that people who are looking to acquire companies have actually slowed down because of this crisis with SVB.
You studied under Randall Krasner, no doubt, at Booth, and maybe even Austin Goolsbee, and they'll tell you in crisis, debt becomes more costlier. You've pointed that out in your note this morning at the summary. The debris of Silicon Valley is there's going to be a new cost to technology and innovation. How large will that burden be?
Yeah, that is going to be a huge burden. So there are two different things here, right? The large corporations and the PE firms who are actually looking to acquire companies, for them, they don't have a debt burden, right? They have lots of capital available, and they can just buy it for cash, which is what is happening with one of our portfolio companies. it is really the small startups and the startups which haven't made it, which actually depend on venture debt from companies like SVB and Comerica and other folks, who are going to have a huge issue because the cost of capital has gone up, right? With SVB, you could get venture debt, for a company that didn't have a lot of revenues, but was backed by investors and by large equity, and SVB would lend against that, and those kind of debt instruments are probably gone for now.
Are you providing capital yourselves, Sapphire Ventures, to your portfolio companies to try to bridge the gap in order to avoid some of those high interest loans?
Yes. So for the first thing that we had to do over the weekend was really figure out how to make payroll, right? And just like a lot of other investment firms, we actually put together a deadline. We were actually, some of our CEOs were going to fund payroll personally, and some of the partners in funds were also going to fund the payroll personally, so that, the employees of these startups didn't have to, go without their pay on Wednesday. But thankfully, that did not happen. But now what is going to happen after all of this is, people are still worried about the cost of debt, how more equity rounds are going to happen. So yes, so we have been sharpening our pencils and looking at all the portfolio companies that might need some more equity funding, in the next 6 to 12 months.
Jay, you said that deals are still getting done at a pretty rapid pace, that there still is lots of interest. I'm curious, especially as a lot of people say, tighter financial conditions, tighter monetary conditions creates more innovation and more stable businesses. But at what cost? How much do you see valuations coming down in order to get some of these transactions done?
Yeah, I think the valuations are all driven by the public markets, right? And, it's kind of interesting. The tech stocks actually went up when, all the crisis happened with SVB. So I think the people who are acquiring, the strategics who are acquiring, they are, taking a long-term view of what they can do with the assets they buy. But definitely the PE firms, they are much more driven by, the multiples. And, so they are definitely looking to pay a less amount of, in terms of, valuation.
Jay, I get the idea that there are banks, entrepreneurial, flexible, maybe they've got a better relationship over a latte in Silicon Valley is the stereotype. Why can't the big banks do this? Why can't Sapphire and others, including startups, deal with Wells Fargo or JP Morgan or the others?
Yes, look, I think it was a matter of trust, right? Because a lot of the times when Silicon Valley Bank did some of their deals, they backed companies with VCs who they have worked with before. And if the company got into trouble, they had the trust that the VCs would come and figure out a way to make that work and make sure that the debt got repaid. That doesn't happen when you have a big bank and you don't have that trust and that relationship. You might have managers, the debt managers, who are not the same over multiple transactions. But this is a matter of trust, right? Because that was the whole thing that is missing when you deal with large banks, where, they're looking at numbers and you can't call up somebody and say, hey, look, they are kind of missing their covenants for a couple of months, and we are going to put in more equity to make them over the covenant, but, give us those 2 months. Those kind of discussions doesn't happen with big debt providers.
Jay, just real quick here, I wanted to follow up on something that you said, where you think that the private markets and venture capital follows the public markets. We saw a 20% decline last year in public markets. They've been whipsawing all over the place. From your vantage point, how much of the decline has already been realized in venture capital, and how much more is there to go?
I think there's still a lot of pain in terms of valuation to go, right? I think, as you saw, the later stage deals have started to happen a little bit. There are some acquisitions that are happening, but they are being done at a much lower multiple. I think there is a lot of companies that have raised capital at really high valuation, and that they haven't gone to the point where they need to raise another round of equity. And those are the companies, I think, in the next 12 months will probably, either have more equity placed into them with some structure to keep the valuation, or the smarter entrepreneurs will actually, take equity at a lower valuation, which actually makes a lot more sense.
Jay, I just want to go full circle on a couple of things, if that's okay. I've got about 2 minutes left with you.
Yeah.
Jay, when this was unfolding last week and you had portfolio companies in SVB, what were you telling them to do?
Well, first and foremost, we were telling them, to figure out how much assets they had in SVB, because, I think about a third of our companies had all their assets in SVB, and some of the other folks had some assets in SVB and in other banks. So the first thing, of course, was payroll, right? Like all of Friday and Saturday, that's all we worked on to figure out how we can make payroll. And then, the second question that everybody had to look at was, okay, which bank should they go and open their accounts, right, to have the second account? They didn't have an account outside SVB.
Yeah.
But, it was all talk about short term, not about long term.
Jay, did you feel like in any way that you were part of its collapse?
No, I don't think we were part of the collapse. I just think that everybody was caught by surprise, by this could unfold so quickly. And when you look at their balance sheet, yes, people don't pay attention to the balance sheet, and the way they structured their the way they invested in treasury bonds. I think if you are an economic student, you would absolutely make sense. But I don't think anybody was paying attention, to their balance sheet.
I just think there's one theory that's doing the rounds, and I don't necessarily subscribe to it. I just want you to respond to it if possible. That VC and your portfolio companies, just as a universe, blew up the bank that served you by all heading to the exit and telling portfolio companies to do the same thing. And then the authorities stepped in on Sunday and basically all made you whole.
Yeah, I don't think anybody did this together as a VCs blew up the bank, because I think if you look at it, we'll have to pay a lot for not only working through the weekend and making sure the payroll is done, but the cost of capital has gone up. If this SVB is gone, as I said, venture debt is not available. It's going to be much more expensive. So I think people knew the ramifications, and I don't think it was a constant, coordinated effort to blow up SVB. I think it was just like anybody else. Somebody on Twitter or heard from their friend that, hey, maybe they're insolvent, maybe we should move the money. And just like anything else, it's a psychological thing, right? As we heard in behavioral economics, right? The bank run is not coordinated. It just happens because once somebody says, hey, we moved our money, and then everybody else started doing the same thing.
It's a classic bank run. Exactly that. Jay, thanks for your perspective. Appreciate it. Thank you. Jay Das there of Sapphire Ventures. Equity futures near session highs up 0.75%. Vince Reinhardt coming up.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. Germany's largest munitions manufacturer says Europe's defense industry can't meet Ukraine's artillery ammunition needs unless governments increase spending to double production capacity. Rheinmetall AG says it's producing at just 2/3 capacity due to lagging orders. Ukrainian and European officials have warned repeatedly that sufficient supply of artillery munitions will prove a decisive factor in the ongoing war. Ron DeSantis, the governor of Florida and likely Republican presidential candidate, expressed strong misgivings over U.S. support for Ukraine in its defense against Russia's invasion, breaking not only with the Biden administration, but other prominent Republicans. DeSantis said in a statement that protecting the U.S. southern border, confronting China, and bolstering the American military should take priority. President Biden has authorized a giant ConocoPhillips oil project in Alaska, despite opposition from environmentalists. The approach represents a middle ground for the president as he seeks to transition from fossil fuels while still being bound by the decisions of past administrations. The project was already approved once under former President Donald Trump. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
was going to keep rate World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
80% of what happened after May 2020 was a mistake. You know, we had a real crisis in May 2020, and thank God they stepped in and did something really radical. And you know, the second and third waves of PPP being indiscriminate was a mistake. Sending checks to everybody was a mistake. Taking interest rates to where they were and then keeping them for that long, it was all a mistake.
Yeah. Except, of course, if you received those checks, and if you received those checks, they felt pretty good. That was Michael Schau there, Market Field Asset Management CEO.
He was fabulous.
He was brilliant yesterday. That full interview on Bloomberg.com and on the Bloomberg terminal if you want to take a look. Let's take a look at markets right now on the S&P. Good morning to you. Up 0.8%. It's a better market so far. Heavily dependent, of course, on what we may or may not get in 43 minutes' time. The CPI report just around the corner. Yields are up 4 basis points on a 10-year. That looks like a normal day, doesn't it? Up 4 basis points on a 10-year. I'll show you an abnormal day. Just look at the 2-year over the last 3-4 sessions. It's up 24 basis points this morning. 2 years, 421. Tom, last Wednesday, north of 5. Yesterday at the close, south of 4.
Yeah, I don't know. Brent crude can't get above 80 this morning, which really has my attention. It's tangential. I get it's tertiary, if you will. But also, we've got to look at these stocks, John. We've had a nice lift in the troubled agony of yesterday and of Friday. And
so First Republic's a name we keep going back to. That stock is up in a pre-market by 44%.
Credit Suisse had last 10
minutes. Credit Suisse recovering.
A little bit more.
Yeah, still down by 1.3%, but certainly recovering. The low was 212 right now. Let's call it 223 and be kind.
We'll have to see. Right now, because of time and to dash into the inflation report in 45 minutes, we're going to pretend there's not a financial crisis. I'm going to ask one selected question here on the history of economics, and John and Lisa will dive into this CPI report. He is Vincent Reinhart. He is chief economist at Dreyfus and Mellon. Far more, he led research at the Federal Reserve System under Alan Greenspan and was considered definitive in herding PhD cats there over wonderful, wonderful research. Vincent, I would love to talk to Chairman Greenspan about this morning, and I'm going to use you as a respected proxy. Were we unmeasured? Did we get out in front of our skis, as the cliche is? I look at the first derivative of this rate rise, and I've never seen a steepness and abruptness on a log axis like we've seen this time around. In hindsight, would you suggest we lost our Greenspanian way and we were unmeasured?
So Alan Greenspan always talked about letting the air out of the balloon slowly. I would go back to the transcripts in 1994 when FOMC participants were just banging on the table about how inflation had gotten out of control. It was important to contain inflation expectations. Sound familiar in any way? And Greenspan just kept saying 25 basis points. Back then, by the way, he was disrespectfully referred to as quarter point Al. And it was with some reluctance that he picked up the pace of tightening. And then they lost control of the narrative. There was at one point...
Did Jerome Powell lose control of this narrative?
I think that he's done a pretty good job at explaining why they're doing it. And look, if he had a 1970s, early 1980s problem, this was serious, and he expressed it with considerable vigor. I think that there's some questions about when they stepped up from 50 to 75. I still have the scars of June 13th when they basically made a pivot in the blackout period. I think there's a question of stepping down from 50 to 25. But let's face it, if you raise the federal funds rate of 1 percentage point in under a year, you are going to break some crockery. And in some sense, the surprising thing, this is not the first time you heard it, how come there isn't more restraint on aggregate demand?
Crockery is a British phrase, in case
Yeah, I'm aware.
I did it for John.
Thank you. I appreciate that, Vince.
Actually, I did a meeting where I said, you're going to break some China, and the client response was, but China's been doing fine.
That's hilarious.
Vince, we have broken some things. We've got some bank failures. And of course, I won't ask you to comment specifically on the nature of the bank failures or on the names themselves. Can you tell me how you think, given what we've learned through history, how this Federal Reserve will confront a bank failure when it sets monetary policy next week? Because you mentioned they've got a 70s, 80s inflation problem. Do they still have a 70s, 80s inflation problem?
First, working backwards, they made some progress. We're talking about something that is much more contained, and progress has its own risk in terms of the dialogue within the committee. It's going to be less pressing a problem for some of the FOMC participants. Second thing, let's go back and who are the Nobel laureates right now? Diamond Dybvig and Bernanke. Diamond Dybvig set up what it takes to have a self-fulfilling run on a financial institution. Boy, you could teach that class out of
Justin Wolfer said the same thing at Michigan.
Fourth quarter call report, and then Bernanke said that if that cascading failures can crimp economic activity. That's about what the triumvirate of regulators did over the weekend. The key issue is the separation principle, which is the view that if you do bank supervision and regulation correctly, then you have a free hand on monetary policy. There's also a dark side to the separation principle, and that is if you decide to deflect the course of your monetary policy, given what you think the aggregate economy is doing, then you're basically admitting you didn't get it right on supervision and crisis management.
Which is the subject of an investigation right now, I believe, at the Federal Reserve in terms of why they didn't see a bigger problem here to begin with. There is this issue, though. If they did come up with this program to stave off some of the systemic risks stemming from SVB, then is there a greater risk in your view that inflation will get out of control, that they will compromise their inflation fighting for a problem that has already been solved and will not have the same disinflationary force?
So I will admit that looking at the call report for SVB brought back terrible memories of the first facts that came through on long-term capital management's balance sheet. And what was interesting about that was both were actually in the public domain. LTCM was reporting to the CFTC. So there's a bit of similarity in that regard. And then the question is, in retrospect, do we think it was appropriate to ease then and keep the funds rate low, even as the economy seemed to weather the blow? If you did crisis management right, you should have a free hand in monetary policy.
This is a psychological question now. Yeah. I think it's actually really important. They're going to sit around the table as a committee, and basically they have to decide whether if they stop hiking, does it undermine the policy they announced Sunday evening? Is that essentially what you're saying?
That's a risk associated with it. I'd say two things about that. First is earlier on you were welcoming Lael Brainerd at the White House.
Yeah.
I was lamenting that the most effective force for policy moderation wasn't going to be on the FOMC table. And that actually matters.
True.
Because, the people talking about 50s, were the ones who were probably least concerned about
This is crucial. Does the president have to step in and say, we're in a crisis, and I would like the vice chairman to stay at the Fed?
Nope.
That's too late.
That's terrible. That train already left the station.
Come on, we're in crisis, she won't be,
and then that's saying you have second doubts about the independence of your central bank.
I do okay there?
You did fantastic.
I'm trying not to get in trouble.
I asked this question of Anne-Marie last week, though, and Vince, maybe we can leave it there. It's a difficult one to answer. I acknowledge that. So if you don't want to go there, don't. I'll go there for you. I asked Anne-Marie whether this administration isn't really thinking too much about the importance of the Federal Reserve to take away the vice chair at the time they took away the vice chair.
I don't think it's particularly unique among administrations not to play the chessboard too many steps forward. And I think it's a reflection of a surplus. The natural tendency would say is the bench depth of good economists who could step in is pretty deep.
Yeah.
And therefore, let's fix our one problem and then go on to the next problem. What that neglects is the culture, the institution, that people just don't. The Senate doesn't act all that fast, and it takes a while to fit in. So that's an issue.
What a tricky moment. Vince, thanks for setting this up. It's such a tricky moment for this Federal Reserve next week. Vincent Reinhart of Dreyfus and Mellon. From New York City, equity futures up 0.8%. Sam Stovall, CFRA, coming up.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Tyree. Coco Gauff opens things up Tuesday at the 5th major when she takes on Sweden's Rebecca Peterson on Stadium 1. The American celebrated her 19th birthday in the desert and would love to give herself the trophy as an extra special present. This will be the first ever meeting between these two on the WTA Tour. And don't forget, you can watch all the action from Indian Wells exclusively live on Tennis Channel.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
To the world of business. Balance of Power is now live from Bloomberg's Washington headquarters at a new time. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players. Balance of Power, now weekdays at 5 p.m. Eastern, only on Bloomberg, your global business authority.
there's a problem with one bank, fear is real.
There's a purposeful effort right now to drain liquidity and drain those deposits.
At the end of the day, the Fed has to keep inflation under control. That's the main focus here.
I think that the Fed is just going to be winging it, which is really what they've been doing all along, right?
I think it's very soon to make a call on the Fed being done.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. 30 minutes from an inflation report was hugely anticipated and tick by tick still anticipated as we look to this financial crisis. What you need to know right now quickly, shares do better. And someone noticing the debris from Silicon Valley, John, is the senator from Massachusetts. I should say in advance that Elizabeth Warren's wheelhouse is bankruptcy. This is her territory.
Wheelhouse is also beating up on Chairman Powell, just for the record, so let's squeeze that in there. Here's the quote from the senator from Massachusetts. Fed Chair Powell's actions to allow big banks like Silicon Valley Bank to boost their profits by loading up on risk directly contributed to these bank failures. For the Fed's inquiry to have credibility, there will be one, Powell must publicly and immediately recuse himself from this internal review. It's appropriate for Vice Chair for Supervision, Barr, to have the independence necessary to do his job. Now, is this just an opportunistic moment for the senator from Massachusetts to take another dig at Chairman Powell, or does she have a point?
It's the structure of the two banks that you and I talked about the other day, and we just spoke to Vincent Reinhart on, who's truly expert. Vincent Reinhart said, don't shake the ship right now, and certainly a Powell recuse would shake the ship. But this is the partition of Brainerd leaving on monetary policy versus Michael Barr on the financial side, the bank side. And I'm going to be clear, Republican or Democrat, Senator Warren speaks with some authority here. This is her academic purview.
It's certainly embarrassing for the Fed chair to be on Capitol Hill doing a testimony on monetary policy 24 hours, 48 hours before a bank collapses in America, talking about increasing the pace of rate increases and without any real idea, seemingly. On the surface, I don't know what he actually knew, but on the surface, it didn't seem like he knew that any of this was going to play out. I will say this, Tom, just on regulation. Back in 2018, a lot of people have talked about the former administration pushing the deregulatory effort. 17 of Senator Warren's Democratic colleagues joined that push as well. So there's a lot of soul searching that needs to take place in Congress down in D.C. on a lot of issues.
We've heard that without question, but Lisa, what this really, really harkens to is the investigative process forward. I mean, we're still not out of this crisis, even with the better stock performance today. And how many hearings, how many studies, how much analysis will there be?
Well, as we look backward, it's also important to look forward. And Vincent Reinhart was kind of brilliant on this, saying that if you manage the financial risk, if you manage any kind of systemic problems in the financial system, then you can let monetary policy have an independent course. Well, that if on the front hand was not done, and that to me really raises a question about the back end. Can they continue to raise rates at a time when people are still worried about financial stability, when you're still dealing with an inflation crisis, and then suddenly we have a real problem, a crisis in monetary policy and credibility?
John, this is the first time in a week I've looked at the ECO screen to look at inflation.
Welcome back to the data.
So it's 0.5% prior. This is the monthly statistic, as Mike McKee said. It's such a jumble now. Don't look at year over year. And we are looking for some form of disinflation from 0.5 down to 0.4. They're in my ear. Get back to the crisis.
So Mike McKee chops it up in 20 different ways, and I'll let Mike do that in 26 minutes. I make it simple. I think for the headlines of the newspapers in this country, the news, your local news, they often go with the headline year over year print. So that's going to be potentially around 6%. That's the median estimate. That's down from 6.4. On Wall Street, big focus on the trend, month over month core. We'll take month over month core. We're looking for that to come in at 0.4, previously 0.4. What Lisa's talking about is vital. What Vincent Reinhart said there 15 minutes ago, the fact that they also have to confront a psychological question on the FOMC next week. Just in this sense, and Priya Misra of TD touched on this too, and I think it's increasingly important as the days go by. They announced a lot on Sunday evening, and they clearly announced it in a way, Tom, that they thought it was sufficient to really insulate the financial system in America. The president came out Monday morning and basically said the same thing. If you've got inflation in around 6%, and as Fed chair you back away for financial stability concerns, are you undermining what you announced the week previously? are you basically suggesting that wasn't enough? Now, maybe they think it was enough and they can go on hiking, but ultimately that psychological question will linger, Tom, about what they should do. Back away, go forward? Does the data warrant it? Do financial stability concerns mean they should pull back?
They got to move the assets out. The fundamental thing to me over the weekend is waiting to see who would take the misery out of these companies. And the key thing is it didn't happen. Banks did not step up to acquire this. I could suggest it's because they didn't give them a great enough haircut. It's just as simple as that. But they had to get there fast for the president's comments Monday morning, and that's what they did Sunday.
The other one to look at, Tom, is in the next week. I've got no idea what the market does, of course. I've got no idea what the print is in 24 minutes' time, but maybe the market starts doing the work for them. Maybe financial conditions do tighten materially. Maybe bank lending standards, Lisa, tighten aggressively as well, given the developments of the last week.
Yeah, but you highlight such an important point, which is if they immunize the financial system and they believe that, then why should they compromise monetary policy at a time where small business optimism came in hotter than expected at 6 a.m. Eastern this morning, when we do see upside surprises in the economic data, and we still are talking about inflation. Again, this is a really difficult moment for them. Perhaps the market will do the work, but will that take care of the inflation that we're dealing with, Tom?
Let's get to the price action briefly. We're up 0.75% on the S&P 500, slightly elevated, just off session highs. I think there's a couple of names I know you will want to follow. Credit Suisse is one. It's down 1.7%, so that recovers off session lows. Near session highs on First Republic and other small banks as well in the pre-market, Tom. So I think it's doing okay so far, about 23 minutes away from that CPI print.
Right now is really important, and we really need to be quiet on Global Wall Street and listen. If you're not part of Global Wall Street, this is your conversation of the day. In the last 24 hours, I've heard 1, 2, 3 people allude back to 1987. Sam Stovall in 1987 was in a hospital because his father was having a routine procedure, and the 23-year-old, or whatever you were, Sam, at the time, was bailing out the legendary Robert Stovall by getting trades done. It was strange in 1987. He now joins us, the chief investment strategist at CFRA, not from a hospital bed. Sam Stovall, very simply, are there allusions here to 1987 where your father was courageous?
Hello there, Tom. Well, I'm amazed. How'd you get all that information? Was that ChatGPT?
ChatGPT. John said to me, check ChatGPT.
Yes. Well, I think we are seeing some comparisons, certainly with the bond market, the decline that we've been seeing in yields today as compared with how sharply they fell back in 1987. And the question being, has the Fed gone too far? So also the question is, will this be throwing us further into recession or the risk of recession? And what's going to happen with the Fed? I think that the Fed will need to maintain credibility, will need to save face, but at the same time, dial back their hawkishness to account for the concern that we're facing right now.
So it sounds like, Sam, you're in the camp where they raise 25 basis points more and then hold. Is that correct?
Absolutely, Lisa. I think the feeling is that because inflation is likely to come in CPI at about 6%, another stair-step downward, core rate also coming in on that year-over-year level that I'm not supposed to be talking about. Again, a positive indication. Retail sales also